If the dollar really does lose its global dominance, the average American isn't just facing headlines. They're facing higher grocery bills, more expensive iPhones, and potentially climbing interest on debt. Think of it as inflation's sneaky little sibling that doesn't leave. You've probably heard whispers that China is accelerating plans to push the yuan onto the global stage, but you may not realize how quickly some countries are actually switching their trade agreements. So how close are we to Ray Dalio's timeline for the dollar's fall? And when will it hit your pocket directly? Why headlines about the dollar suddenly got louder? In early 2025, the headlines about the dollar's position in the global system started showing up not only in financial newspapers, but also in everyday outlets. Suddenly, news anchors who usually save time for sports or celebrity gossip were running stories about currencies, central banks, and reserve holdings. What changed is that the subject no longer looked like an academic debate hidden in research papers. It became a practical issue that economists now link directly to how much households pay at the store and at the gas station. The shift is striking because for years, currency dominance was considered a background condition of the global economy, something reliable and barely worth mentioning in daily news. But the volume and tone of coverage in 2025 signals a break from that comfort. The explanation lies in the growing number of trade deals that exclude the dollar outright. When nations reroute their settlements into other currencies, they set the stage for practical consequences. These agreements, once scattered or symbolic, have now reached enough scale to carry weight. 10 years ago, a trade deal between two mid-sized economies choosing to settle in non-dollar denominations might have been filed away as diplomatic theater. Now, the accumulation of these agreements is substantial enough to matter. Each one may look modest, but together they slowly erode the role of the dollar as the default settlement tool. This is the reason mainstream networks, not just financial publications, are carrying the story with more urgency. Currency news usually felt far away because of its technical nature. A household buying groceries or paying rent rarely thinks about World Bank data or reserve ratios. Yet economists point out that the chain from foreign exchange markets to consumer prices is more direct than many assume. A currency losing ground affects borrowing costs, which influence the interest rates for mortgages, credit cards, and government debt. That, in turn, shapes inflation trends. When inflation stays elevated, prices for imported goods become even more sensitive to exchange rate changes. In 2025, with living costs already high from years of economic uncertainty, people no longer dismiss this as abstract. They feel it at the cash register. Newsrooms picked up on this connection and began framing stories about the dollar with a household angle, which gave the topic broader reach. What used to be considered an academic conversation about global reserve status has entered the realm of policy action. Governments are no longer just debating the merits of de-dollarization in think tank circles. They are signing agreements and announcing frameworks that shift real flows of money. That transformation signals why headlines grew louder. The topic jumped from being intellectual speculation to being demonstrated in practice. Policymakers in different regions, often frustrated with how exposed they feel to decisions in Washington, are actively designing workarounds. Even if some experiments remain limited, their existence changes the perception that the system cannot be altered. Once a precedent is established, more countries feel encouraged to consider their own alternatives. The consequence is that discussions about reserve currencies no longer attract only historians or monetary scholars. Businesses are paying attention too. Corporations with supply chains spread across continents are calculating whether an erosion of dollar convenience would affect transaction costs. Energy companies are monitoring whether more clients request settlements in other currencies. Banks are adjusting their strategies to include hedges that account for subtle shifts away from the dollar. All of these developments then spill into news coverage, creating attention far beyond what the subject once commanded. Another reason the conversation tightened in 2025 is that the timeline of change has become visible. For years, critics claimed that global reserve structures move at such a glacial pace that no current generation needs to worry about them. But recent years show adjustments happening quicker than expected when compounded together. The dollar's share of reserves has not collapsed, but it has contracted enough to break prior forecasts. These changes push analysts to renew projections, and those revisions give journalists new leads to cover. The story is no longer about predictions made decades in advance. but about ongoing moves unfolding right now that set up the trajectory of the next decade. Consider how much of this debate once stayed confined to conferences and closed-door discussions. Academics would present data, policy think tanks would publish reports, and the broader public would hear nothing. In 2025, however, signs of change appear tangible enough for the public to recognize. The sudden consistency of coverage reflects the fact that a threshold has been crossed. This is not speculation to file away, but a turning point visible in real markets and policy announcements. That is why headlines feature words such as decline, erosion, or replacement rather than simply discussion. The tension lies in how the story was framed before. For years, advocates for de-dollarization were dismissed as fringe voices insisting on unlikely change. Economists at mainstream institutions would often call the dollar's dominance unshakable. The contrast now is that those same institutions publicly note the shifts with seriousness. The academic margins have moved into mainstream acknowledgement. That change in tone is what audiences pick up. They no longer hear about this only from niche commentators. Instead, they see officials, central bankers, and mainstream economists speaking about risks. This development transforms perception. What was once labeled as unrealistic is becoming increasingly accepted as plausible. The practical outcome is a ripple effect across the global economy. As countries explore settlements outside the dollar, the financial markets adjust in anticipation, not after the fact. Investors reprice assets, foreign exchange traders adjust strategies, and multinational firms consider building new systems for payments. The buildup of these decisions amplifies the influence of each new agreement between states. In economic terms, expectations often drive reality. The moment enough participants believe the dollar is less unique, they change behaviors in ways that reinforce that belief. This is the loop currently underway, which explains why the media narrative accelerated. Part of the intensity in 2025 also owes to how this story intersects with broader economic pressures. With inflation stubborn in many regions and interest rates already high, households worry about affordability. Currency weakness compounds those fears. Policy decisions in Washington about deficits and borrowing get reinterpreted through the lens of whether global markets will continue financing them under the old assumptions. That extra scrutiny filters into coverage because it fuels political debates at home. If the U.S. can no longer assume unlimited demand for its bonds, the domestic consequences become weightier. Journalists seize on those stakes because they generate both political drama and economic significance. The other amplifying factor is the way alternative blocs are structuring their financial arrangements. Groups of countries are consolidating their positions, making the choice to avoid the dollar less about symbolic resistance and more about establishing independent systems. Importantly, not every participant shares the same motivation. For some, it is about gaining protection in a turbulent world. For others, it is about expanding influence. The diversity of motives shows that this trend is not driven by a single actor pushing an agenda, but by a collection of different strategies all aligning on the same practical step: reducing reliance on the dollar. That alignment enhances credibility, which makes the story louder. In effect, the frequency of headlines is a measure of how far the conversation shifted away from theory. The more countries act on the subject, the more businesses adapt, and the more consumers feel side effects, the louder the story becomes. This is why in 2025 it crossed from economic background noise into mainstream awareness. The media is responding to tangible activity, and audiences are responding because outcomes affect their lives. The mini payoff here is simple: de-dollarization is no longer a niche topic. It is seeping into actual transactions, influencing market behavior, and showing up in everyday costs. When usually slow-moving discussions reach this scale of attention, it marks the beginning of a real economic current rather than a passing idea. And that current is what global markets are starting to navigate today, setting the stage for shifts that will define the coming years. In the coverage pattern, this moment feels like moving from a whisper to a conversation. Each fresh report signals that the protection the dollar once enjoyed as an unquestioned standard is giving way to a landscape where alternatives are multiplying. That recognition does not mean instant replacement, but it shows that primacy is being challenged in meaningful ways. Once a system accepts that alternatives are both possible and active, the stability that supported dollar dominance begins to weaken, even without dramatic events. This is why mainstream headlines across 2025 are louder, steadier, and more focused on the dollar's position than at any point in recent history. The shift is not just intellectual, it is embedded into actual economic flows, and that is what gives the story its weight. What remains most important is that the conversation itself reinforces the reality it describes. When journalists repeat, investors adjust, and policymakers respond, the idea that the dollar can decline becomes entrenched in public thinking. And that shift in mindset increases the likelihood of further practical steps away from dollar usage. In simple terms, 2025 marks the year when the discussion about currency dominance stopped belonging only to theorists and became part of the daily economic environment shaping choices across the globe. China's push. How the yuan is climbing the ladder. China has never hidden the fact that it wants the yuan to play a larger role in the global system. And in 2025, that ambition has become clearer through a mix of policy moves and trade arrangements. Where earlier efforts looked like tentative experiments, the past year has made it obvious that China views currency power as part of its long-term strategy. The yuan is no longer treated as a purely domestic tool. It is now being positioned as a competitor in trade, finance, and international reserves. Beijing has not declared it wants to dethrone the dollar outright, but the design of recent policies suggests that steady erosion of American currency primacy gives China leverage in negotiations, in diplomacy, and in economic influence. One of the clearest signals came from oil payments. Several major producers are now willing to receive yuan in exchange for crude exports, and China encourages this by offering liquid trade channels to settle the transactions. Energy trade has always been a key pillar underpinning the dollar's dominance, so the fact that suppliers agree to accept yuan represents more than just a symbolic gesture. These payments create precedents that normalize the yuan in sectors outside its home region. Once enough trade flows are settled in a currency, banks, traders, and governments begin to hold more of it to reduce exchange risk. That process slowly builds the infrastructure required for a reserve currency. China's oil deals demonstrate how targeted settlements in specific industries can boost a currency's global profile without requiring sudden, sweeping adoption. The expansion of BRICS adds a second dimension to this push. With new members, the bloc now commands a larger share of global trade and production. What matters most for the yuan is that these countries are either neutral toward American influence or actively looking for alternatives. The group's joint statements and projects highlight the need for financial systems that bypass the dollar. While not every member agrees on a single vision, the collective momentum works in China's favor. Its financial networks already underpin large parts of the bloc's transactions, and the adoption of yuan in cross-border settlements within BRICS shows how membership expansion amplifies China's reach. The symbolism of a major bloc supporting non-dollar trade translates into concrete flows whenever deals are arranged in yuan. Despite these advances, one persistent obstacle remains: China's own control over its capital markets. For all its external ambitions, Beijing still restricts the free movement of capital inside its borders. Global investors hesitate because they cannot easily move money in and out, and that constraint is critical when evaluating a reserve currency. Reserve status requires not just use in trade, but deep, open markets where the currency can be invested, borrowed, and hedged with confidence. China's refusal to liberalize fully keeps large-scale adoption at bay. Even allies or partners willing to trade in yuan often choose to convert surpluses into other holdings afterwards. This tension between external ambition and internal control illustrates the core barrier China faces. A currency cannot dominate if its issuer maintains walls that prevent smooth flow across borders. Yet visibility is often half the battle in financial systems, and the yuan's visibility has surged. Trade agreements repeatedly include provisions for currency settlements in yuan. Regional partners, especially in Asia, accept deals that previously ran exclusively through the dollar. Even in regions far from China, governments now weigh whether denominating part of their trade in yuan makes sense when negotiating with Beijing. Visibility matters because it habituates actors in the system. The more they see yuan being used, the more common it feels to accept. This growing presence signals progress regardless of whether capital markets remain partially closed. While the yuan is far behind the dollar in reserves, the fact that it routinely appears in trade flows establishes a foundation for future influence. What was once unthinkable, oil denominated in yuan or settlements in African resource projects, has now happened often enough that the market no longer treats it as unusual. China does not need rapid replacement of the dollar for its strategy to succeed. Gradual erosion of dominance suffices. Every transaction in yuan is one fewer in dollars, and every reserve shift away from the dollar reduces Washington's ability to dictate financial terms globally. Erosion strengthens China, even if the yuan does not attain top status. With steady gains, Beijing can negotiate trade, investment, and geopolitical decisions from a position of greater leverage. A full replacement might not even be China's realistic goal in the short term. Instead, creating multiple options diminishes America's exclusive power. In a system where dependence is spread out, influence becomes multipolar. This condition improves China's standing in disputes, in trade talks, and even in military tensions, since financial leverage underpins much of diplomacy. The mechanism through which China raises the yuan's profile is not only trade agreements or BRICS. Infrastructure lending provides another channel. Through projects funded by its state-controlled banks, China can require or encourage repayment in yuan. These flows cement the currency's presence in regions that otherwise would rarely touch it. As infrastructure loans mature, borrowers accumulate yuan balances, which then cycle back into trade. The system gradually locks participants into routines that strengthen the yuan's role. While repayment terms may look like normal financing, the added effect is a persistent presence of Chinese currency beyond its original market. When these practices spread across dozens of countries, familiarity with yuan transactions expands far more than through voluntary deals alone. China also pairs financial efforts with technological innovation. Payment systems that operate outside Western dominance give partners confidence that yuan settlements are reliable, even if American sanctions affect dollar-based systems. These payment networks reduce the risk that external political decisions could cut off flows. For countries wary of dependence on Western banks, Chinese alternatives look practical. Participants often emphasize that even if the yuan never replaces the dollar, having an electronic system to process trade in yuan secures them from being trapped. This technological layer builds infrastructure that consolidates China's currency ambition. The role of payments is less visible than reserves data, but it matters immensely because it underpins trust in daily transactions. China's strategy also exploits gaps created by American policies. When Washington imposes sanctions or demands compliance through dollar channels, targeted countries look for alternatives. Yuan use has grown most rapidly in places where sanctions make dollar access risky. This demonstrates how political actions accelerate shifts that economic logic alone might have taken decades to achieve. By being available as an alternative, the yuan transforms signs of resistance into practical adoption. Even small shifts produce headlines, and those headlines in turn normalize more use. America's enforcement power indirectly contributes to the yuan's visibility, since resistant countries must find a workable transaction tool, and China is ready to provide it. Still, adoption at scale requires more than strategic openings. Trust in the issuing government's predictability remains crucial. International investors remain cautious due to concerns about sudden changes in China's policies. Currency dominance relies on credibility, and credibility grows from decades of consistent practice. China's shorter track record creates doubts that slow progress. Countries may use yuan in specific trades, but hesitate to hold large reserves of it. This limitation keeps the dollar's share dominant. The barrier may persist until China demonstrates steadier transparency, which so far remains unlikely given its governance model. As a result, the yuan gains attention without capturing the depth of trust that underpins the dollar. Yet, these limitations do not negate the progress achieved. The yuan has shifted from being a regional currency to a tool with global reach. Its role in oil payments, infrastructure finance, BRICS trade, and sanctioned markets shows that China has successfully opened channels of regular use. While barriers prevent a giant leap into reserve dominance, incremental advances serve China perfectly. Each step erodes the sense of inevitability around the dollar. That erosion is precisely the leverage Beijing seeks. The path forward is less about overtaking and more about balancing. By balancing, China forces a redistribution of global influence that undermines the once exclusive privilege of the United States. When viewed in the context of the past few decades, the current position of the yuan looks remarkable. From near invisibility, it has achieved global presence in energy, infrastructure, and regional settlements. The gap with the dollar remains vast, but the perception of momentum is enough to influence decisions by governments and businesses alike. Momentum ensures that even without breakthrough liberalization, actors will continue to experiment with yuan transactions. Each experiment makes it harder for the world to imagine a dollar monopoly. That change in imagination is crucial because it sets the direction for policy, investment, and trade. The significance is not whether the yuan is ready to replace the dollar tomorrow. It is that the yuan has become an acknowledged pillar of the long game. China sustains its trajectory by concentrating on steady gains, by embedding its currency in sectors where influence is strategic, and by normalizing its use to the point where exclusion feels incomplete. In a system where every marginal shift matters, China has secured the advantage of persistence. That persistence transforms small flows into leverage. Where 2025 stands is not at the moment of replacement, but at the recognition that alternatives to dollar dominance are not speculative fiction. They are lived experiences, accumulating month by month, all tied to the steady climb of the yuan's reach. The 2025 Reserve Currency Breakdown. Looking at the most recent data from the IMF and World Bank, the dollar still commands the single largest share of official foreign exchange reserves, but the direction of the trend is not flattering. Central banks continue to hold a majority of their wealth in dollars, yet the percentage has fallen more quickly than anyone projected just a few years ago. When the last major forecast cycles were published, analysts assumed erosion would be slow, predictable, and modest. Instead, the last 3 years show movement that outpaced those expectations, creating a sense of uncertainty about the pace ahead. The dollar remains the anchor, but that anchor is no longer as heavy or immovable as it once seemed. To put this into context, looking back over the past 2 decades shows remarkable stability. For much of the early 2000s, global holdings of dollars in reserves hovered around levels that seemed permanent. The euro chipped away in places, and other currencies appeared in the margins, but the basic architecture never looked threatened. In those days, the dollar's share was nearer to 2/3 of total reserves across central banks. That share has since fallen into the upper half range, leaving a noticeable gap compared to the past. What looks like a few percentage points on a chart translates into hundreds of billions of dollars in actual reserves redirected elsewhere. Scale matters here, and losing even a sliver of market share represents significant shifts in global choices. It becomes more striking when you compare today with the last 3 years alone. From 2022 to 2025, the decline ran faster than the models projected. Analysts who anticipated a gradual reduction over a decade now admit the trajectory compressed. Even with expected rebounds here and there, the underlying slope demonstrates persistent slippage. That slippage is not catastrophic, but it is visible, and visibility is what grabs attention among policymakers, businesses, and markets. Numbers do not have to collapse to signal a problem. They only have to trend in the wrong direction at a quicker clip than anticipated. Once that happens, conversations about urgency begin, and those conversations feed into headlines around the world. The dollar continues to enjoy inherent advantages that alternative currencies lack. It represents the deepest financial markets, still highly liquid, with unparalleled accessibility for investors. But dominance works best when it looks unquestionable. What has shifted is that the element of certainty has been replaced with a growing recognition that alternatives are gathering strength, even if collectively rather than individually. The yuan, the euro, and to some extent other regional currencies carve out modest shares, and each gain adds to the cumulative effect. The dollar remains center stage, but you could think of it as a television reality show. It is still the lead character, with the storyline revolving around it, but episodes now give more screen time to side characters. That reduced exclusivity captures the idea that the star is still the star, yet the narrative no longer belongs entirely to it. This shift carries psychological weight. Central banks allocate reserves with long horizons in mind. Sudden changes are rare, gradual repositioning is more typical. When multiple institutions independently recalibrate their allocations over just a few years, that indicates a broader reassessment of trust, not a coincidence. Policies in Washington, especially fiscal choices and debt ratios, influence how reserve managers think about risk. They do not necessarily panic, but they account for the possibility that exposure to the dollar could bring higher volatility than before. placements into other currencies provide a hedge. Collectively, those hedges add up, and the data shown by the IMF captures that accumulation. The more visible those reallocations become, the more confidence other central banks gain in doing the same. It forms a reinforcing loop. Historically, the slow-changing nature of reserve distributions meant that any shifts were expected to unfold over decades. That remains broadly true, but the fact the decline is faster than earlier models predicted introduces doubt about how long the dollar can expect to sustain its extraordinary share. Each report fuels arguments that the turning point is sooner than previously thought. Analysts who once dismissed the subject outright now describe erosion as genuine, if not yet monumental. Overshoot in predictions is common, but what is new is the realization that the dollar is not immune from accelerated rebalancing. The slope on the chart hints at potential momentum. Momentum is often more significant than the level itself, because it shapes expectations of the future. Reserves data also reveal where the pieces of market share are going. The euro continues to hold a notable portion, a legacy of Europe's large economy and established bond market. The Japanese yen and British pound remain traditional components, though their shares have barely shifted in relative terms. The yuan, however, while still smaller in comparison, has logged steady growth. What matters most is not the absolute size, but the trajectory. Consistent gains, even from a small base, suggest momentum that may compound in coming years. This reinforces the sense that the system is moving from unipolar dependence on the dollar toward a more diversified structure, where multiple currencies share influence. That diversification indicates insurance against American fiscal or policy shocks. Yet even as the numbers show slippage, the dollar retains crucial dominance. Its network effects are formidable. Most global trade invoices remain denominated in dollars, and the habit of using it across markets creates inertia. Central banks still see it as the primary refuge in times of crisis. Its deep treasury market serves as collateral across the global financial system. Without these advantages, the pace of decline might look sharper. But with them, erosion remains measured, not catastrophic. Investors recognize that carelessness in American policy could accelerate diversification, but stability and liquidity still tether the dollar's role. That tether keeps the erosion from spiraling downward quickly, even if smaller drains continue year after year. A reality check is important. The dollar does not face elimination as a reserve currency. What it faces is gradual adaptation to a world where alternatives are treated with more seriousness. Losing a few percentage points over 3 years may not look disruptive at first glance, yet the meaning lies in comparison with past decades of remarkable stability. For a long time, the global system assumed the shares were frozen. The past several years prove that assumption wrong. If anything, the loss of predictability is the more significant outcome. Investors and governments alike must now consider that the trajectory has tilted, and tilting in this context challenges what confidence once relied on. It's also worth considering how this environment influences politics. In Washington, policymakers are concerned about foreign willingness to finance large deficits. If reserves allocation gradually leans toward alternatives, America's borrowing convenience may not disappear, but it weakens. Slightly higher yields on treasuries or increased investor skepticism reverberate across domestic mortgages, loans, and consumer credit. What begins as a quiet statistical change in central bank reports filters down into household economics. That link gives the story popular relevance, explaining why headlines now frequently highlight the breakdown of reserve ratios. Declines in share are not just international bookkeeping. They flow into tangible costs in daily economic life. Comparisons with history add another layer. Referencing earlier reserve currencies shows that decline rarely comes with a sudden crash. The pound sterling took many years to surrender dominance, even after Britain's relative economic position weakened. The lesson is that longevity persists further than logic sometimes expects. The same principle applies here. The dollar will not be replaced instantly, but its trajectory reveals a weakening grasp. Every step down may appear modest in isolation, but as in all compounding matters, increments accumulate. That accumulation shapes structural reality, especially when mirrored by parallel systems forming in the global economy. In financial markets, perception matters as much as data. When investors and policymakers read IMF reports and see numbers shifting faster than previous models anticipated, they assign higher probabilities to continued erosion. Those probabilities inform investment decisions, currency hedges, and even diplomatic strategy. When the perception sets in that the dollar's dominance is not guaranteed, behaviors solidify to accommodate that possibility. The importance of this perception cannot be overstated because it locks into future expectations, which themselves influence allocation. This feedback cycle underlines the challenge the dollar now faces. Thus, the picture by 2025 is nuanced. The data confirm the dollar remains dominant by far, but it also shows that dominance is not untouchable. In earlier times, many assumed its supremacy was permanent, a bedrock of the financial order. The present chart demonstrates otherwise. The more that share slips, even slowly, the more participants across the system treat alternatives as a serious component of planning. That recognition does not herald immediate replacement, but marks a decisive turning point in how the future is envisioned. Dominance is no longer unquestioned. It is respected, but it is leaking share gradually. And in the world of global finance, steady leaks reshape the structure much more profoundly than sudden shocks. This explains why discussions of reserve breakdown now carry weight beyond academia. The numbers matter because they are not just numbers. They represent decisions by central banks worldwide, and those decisions crystallize global confidence. Confidence has shifted enough to make people wonder not whether the dollar will decline, but how quickly and how decisively. That open question never existed in mainstream thought before. The data in 2025 solidify it as part of common conversation. The dollar still tells the main story, but its prominence in the narrative is being trimmed back with each passing season, like a star learning to share time on the screen while newer characters test their lines. Ray Dalio's predictions, coming true or overblown. Ray Dalio has built his reputation not just as a hedge fund manager, but as someone who tries to explain the bigger picture of how economies rise and fall. For years, he's argued that America is midway through a decline in its financial dominance, pointing to debt levels, widening inequality, and political gridlock as markers of the stage. His broader framework is what he often calls the cycle of empires. In his view, every dominant power eventually follows a similar arc: rapid growth, consolidation at the top, followed by stagnation, excessive borrowing, and eventually loss of primacy. In 2025, the appeal of this theory has grown because the data on U.S. debt, strained diplomacy, and the dollar's slipping share in reserves all appear to line up with parts of his story. The question now is not whether the United States faces challenges, but whether Dalio's framework maps too cleanly onto these developments, making trends look more inevitable than they are. The cycle Dalio sketches is straightforward on paper. An empire builds its strength through production, innovation, and global trade. Over time, financial dominance allows it to borrow cheaply in its own currency, which further reinforces its position. But once that privilege is abused, through overuse of credit, rising deficits, and complacent governance, the system tips into decay. At the later part of the cycle, the empire still looks powerful in military and cultural terms, but its finances grow fragile. Dalio traces this path across examples like the Dutch in the 17th century, the British in the 19th and early 20th, and now the Americans in the late 20th and 21st. Each followed the same rhythm: rapid expansion, global reach, reliance on debt, and eventual displacement by the next rising power. The simple version of this narrative feels persuasive because it connects distant historical cases with present concerns. Yet mapping one onto the other is less straightforward when you examine the details. In the American case, 2025 provides both evidence for and against his argument. Debt has climbed to historic highs, and government borrowing continues at a pace that earlier economists might have considered alarming. Investors have demanded higher yields on U.S. bonds, signaling at least some reduction in trust. When Treasury rates rise not because of rapid growth, but because of risk perceptions, Dalio would say this demonstrates the later stages of the cycle. Internationally, partners voice frustration over the dollar's role as a political tool, citing sanctions or financial pressure as reasons to diversify. The reluctance of some foreign funds to keep expanding U.S. bond holdings confirms that distrust is spreading beyond rhetoric into actual choices. These are the types of signals that his theory predicts, and in that sense, parts of the present landscape appear to validate his warnings. But not everyone agrees the future will follow his timeline. Many economists point out that the dollar's depth and the massive scale of U.S. financial markets remain unmatched. Unlike Britain after World War II, the United States is not watching an empire collapse under the pressure of rebuilding costs, nor is its currency bound to a system like the gold standard that constrains flexibility. Instead, America issues debt in the world's preferred safe asset, and that unique quality has no true alternative. Even when frustrations with Washington mount, investors often circle back to U.S. assets at moments of crisis. This reflex, known as the flight to safety, illustrates resilience that Dalio's broader cycle may underemphasize. The dynamic reinforces the dollar's influence even as its share erodes, slowing the timetable his predictions suggest. The strength of his theory rests on recognizing patterns that repeat over centuries. That makes it attractive as a teaching device, but it can also simplify complex systems. Take the question of foreign distrust. It is true that more countries are trying to settle trade in other currencies, and central banks are diversifying reserves inch by inch. Yet one reason they can afford to experiment is precisely because the dollar remains a bedrock. Its liquidity acts like an insurance policy, allowing other currencies to grow without assuming the full burden. This complexity demonstrates that decline is less about neat stages on a timeline and more about layers of adaptation. Assessing the U.S. using Dalio's framework provides clarity, but perhaps too much clarity, because it presents the process as inevitable rather than contested. Another layer of skepticism arises when you look at the speed of shifts. Reserve currencies historically take generations to be replaced. Even the British pound, after 2 global wars and deep financial strain, held significant reserve share well into the post-war period. The dollar has built its position in an age of unprecedented globalization, supported by technology, capital markets, and the dominance of U.S. firms in finance, software, and intellectual property. These factors stretch the cycle longer than Dalio might expect, because they anchor trust differently than centuries past. While his map of empires rising and falling provides a compelling narrative, timelines in today's interconnected economy do not always mirror those examples. Dalio's predictions align most strongly with 2 aspects of the present: rising debt service and foreign skepticism. The U.S. government has reached a point where a larger share of its annual outlays goes to pay interest on debt. This echoes the scenario he describes, where borrowing costs become a burden rather than a tool. In parallel, the skepticism of major reserve holders is visible. Adjustments in their reserves show a cautious but real exploration of alternatives. These 2 trends confirm his argument that the late cycle is characterized by both internal financial stress and external doubts. The implications are serious. If trust erodes further, the United States could face a cycle of paying higher rates just to attract the capital it once enjoyed effortlessly. That dynamic places pressure not just on the Federal Reserve, but also on Congress, since fiscal deficits feed directly into this vulnerability. On the other side of the argument are the built-in strengths of the American position. The country still houses the world's deepest credit markets, with legal systems trusted to protect property rights and a political structure, however dysfunctional, that supports continuity through crises. When central banks diversify, they do not usually abandon the dollar entirely. Instead, they lighten exposure while maintaining large holdings. This pattern suggests adjustment rather than collapse. Economists who view Dalio's warnings as overstated emphasize that adjustment is very different from breakdown. Shaving a few percentage points off the dollar's global reserve share does not imply it will disappear from its dominant role. Even losing a quarter of its share would still leave it far ahead of any single competitor. The middle ground between these views is where the current reality sits. Dalio diagnoses concerns accurately. High debt, geopolitical strains, and slower growth place pressure on the system. But his interpretation of timing may compress too much into one era. The United States may face erosion, but erosion in financial systems often spans decades rather than single cycles. The evidence from 2025 proves that slippage is real. What it doesn't prove is that a reset is imminent. Investors and policymakers, aware of the data, hedge accordingly without assuming the end of the dollar's primacy tomorrow. The practical effect of Dalio's visibility is that his ideas shape public discourse. When broad audiences hear about empire cycles, they begin framing events through that lens. This framing influences how people interpret updates on debt levels or international agreements. In other words, whether or not his theory nails the details, it captures enough attention to sway perceptions. And perceptions themselves matter in global markets because they influence decisions. If too many actors believe the dollar is weakening, their behavior makes that outcome more likely, even if fundamentals could have supported longer stability. In summary, Dalio's predictions are neither perfectly accurate nor entirely unfounded. They sit in an uncomfortable middle. Some elements look validated by growing distrust and higher yields, while others still fall short when faced with the reality of the dollar's resilience. His insistence on cycles makes trends appear inevitable, but history demonstrates that inertia and structural depth slow change. What 2025 proves is that pressure exists, but the timeline for transformation remains contested. Dalio may be too aggressive in his forecasts, yet the themes he highlights are more relevant than most analysts imagined. The dollar faces tests, not collapse, and those tests will shape how much of his empire cycle ultimately plays out in the present era. BRICS expansion, the dollar's new rival club. The grouping we know as BRICS started as a loose acronym, but by 2025 it has evolved into something closer to a coordinated club with distinct financial ambitions. What once looked like a diplomatic talking point has matured into a bloc that carries real economic weight, and recent expansions only amplify that influence. With more members now formally inside the tent, the scope of BRICS trade covers a wide mix of resources, manufacturing capacity, and consumer demand. This variety creates fertile ground for experimenting with non-dollar settlements. As the collective footprint grows, so does its leverage, because trade volumes within and across these countries are large enough to support meaningful currency alternatives. For the yuan in particular, this expanded environment provides a natural ecosystem where China can push its financial agenda without relying on Western structures. The scale of commerce among BRICS members and their new participants is significant for understanding the potential impact on global currency use. When countries in the bloc negotiate terms for energy sales or infrastructure financing, they increasingly talk about bypassing the dollar. The motivation is straightforward. If partners already conduct such a large percentage of their trade with one another, why insert a third currency into the mix? Settling directly in local currencies, or more often in yuan, sidesteps the transaction costs and political risks associated with dollar clearing systems. The growth in membership deepens this logic, because each added participant offers another layer of trade where dollar exclusion can be tested. Every time one of these deals lands on paper, it represents not just a symbolic challenge to the dollar, but a measurable reallocation of monetary flows. The effectiveness of BRICS as a rival bloc stems from both size and diversity. Brazil and Russia bring vast natural resources. India contributes a large labor market and service sector. China offers industrial power and financial networks, while South Africa anchors regional access in the African continent. Expanding into additional members brings energy producers from the Middle East, as well as trading hubs in Africa and Asia. The magnitude of this combined activity transforms what used to be isolated bilateral experiments into a system with real momentum. For the yuan, each new oil shipment priced outside of dollars, each infrastructure deal settled in local currency, and each bank line denominated in yuan adds bricks to the wall of credibility needed for internationalization. But coordination within BRICS is not smooth. Each member arrives with different priorities, political interests, and levels of trust toward China. India, for example, remains cautious about allowing Beijing too much influence over regional finance, preferring to maintain its own autonomy. Brazil and South Africa focus more on leveraging collective bargaining power than on currency agenda setting. Russia, grappling with sanctions, sees the yuan as a vital escape route, but may not align fully with China's long-term institutional frameworks. These divergent interests often slow progress when the group attempts to design a shared financial architecture. Summits end with statements of intent rather than concrete rules, showing the tension between ambition and political reality. The club has scale, but that doesn't automatically translate into smooth cooperation. Despite that friction, the underlying incentive to move away from the dollar unites the members more effectively than their differences divide them. Each has lived with the downsides of an international system tied so tightly to Washington. Whether it's vulnerability to sanctions, exposure to U.S. interest rate cycles, or sensitivity to political disputes, reliance on the dollar carries risks that sovereignties prefer to limit. The beauty of BRICS expansion is that members need not fully align on everything. As long as each one decides that reducing dollar dependency serves national interest, collective direction is preserved. The yuan often serves as the practical answer, because China stands willing to supply liquidity, infrastructure, and banking pathways that allow these arrangements to operate. So while meetings can stall over details, the broader push still marches forward. The transformation of BRICS from rhetoric to reality becomes especially clear when you look at the volume of trade now being conducted in non-dollar currencies. A decade ago, agreements mentioned this possibility, but actual flows were small. By 2025, accounting systems and financial institutions within the bloc handle enough transactions in yuan or local denominations to show up in global data. These are no longer talking points. They're transactions being recorded, banks processing settlements, and central banks adjusting reserves accordingly. The cumulative outcome is that symbolic gestures have become measurable actions, with balance sheets across continents reflecting the changes. That shift is where the credibility lies, because measurable actions matter far more than declarations. Part of what makes BRICS expansion consequential is the ability to test and scale alternatives in manageable environments. A single bilateral deal between China and a partner can raise questions about mutual trust or long-term sustainability. But when replicated across multiple members, the experiments reinforce each other. One energy transaction settled in yuan may be dismissed as a trial. Dozens of similar contracts across member states, however, create momentum that normalizes the practice. The expansion provides new testing grounds, and once a method is tested widely enough, systems and practices solidify. BRICS therefore acts as both laboratory and amplifier for non-dollar finance. The external perception of BRICS also feeds into its impact. International observers compare its collective GDP and trade volumes to existing Western blocs and institutions. That framing alone grants it symbolic power beyond the hard numbers. Symbolism matters because when investors, policymakers, and media observe a bloc growing in both size and cohesion, they begin anticipating more influence. Expectations often move markets before actual transactions do. The perception that BRICS represents a credible rival center of economic power strengthens the legitimacy of non-dollar alternatives. This legitimacy makes it easier for individual members to justify their moves domestically, saying they are part of a larger global trend rather than acting alone. Another critical point is energy. BRICS expansion includes states whose economies depend heavily on energy exports. Since energy is globally traded at massive scale, even small shifts in the currency used for settlement carry outsized influence. A handful of contracts priced in yuan rather than dollars affect not only the two counterparties, but also benchmarks, derivative markets, and reserve hedging strategies. As energy producers integrate into the bloc and start accepting yuan, the practice becomes credible enough for others to follow. This potential is why analysts watch energy deals within BRICS so closely. It is one of the fastest pathways toward real de-dollarization rather than symbolic posturing. The expansion also amplifies China's financial infrastructure projects. When BRICS members sign onto cross-border payment systems managed by Chinese technology, they plug directly into the yuan's ecosystem. What once looked like regional pilot programs now spread across multiple continents. The more members use these systems, the more entrenched they become. Over time, the reliance on that infrastructure generates inertia. Countries may not originally intend to shift reserves in large amounts, but as they transact more frequently in yuan, holdings accumulate naturally as buffers. This accumulation then cycles into reserve data, reinforcing the global narrative of dollar erosion. At the same time, political divergence keeps these efforts from evolving into a smooth, unified system. Disagreements surface over governance, distribution of influence, and the degree to which China dominates the frameworks. Some members worry about substituting one dependence for another. Others fear giving up too much flexibility. These suspicions ensure that projects take longer to develop and some initiatives lose steam. Yet, despite the hesitation, the common denominator, reducing exposure to the dollar, remains appealing. Even when coordination is messy, the shared incentive nudges everyone in the same direction. Realpolitik dictates that no single member will abandon the experiment entirely, since the benefits of diversification are tangible. Ultimately, the effect of BRICS expansion is to make de-dollarization credible at the scale of actual trade data. Symbolic declarations once generated the headlines, but in 2025, measurable flows prove the story has shifted. Statistics report the yuan's growing role not because of speculation, but because contracts, reserves, and payment systems show it directly. The block size transforms the idea from a fringe notion into an economic reality that appears in international accounts. The mini payoff here is straightforward. BRICS expansion has pushed the notion of de-dollarization beyond political theater. It now shows up in measurable trade, where energy contracts, infrastructure loans, and financial settlements are increasingly denominated in currencies other than the US dollar. By creating a larger ecosystem with enough scale to support these choices, the bloc makes currency alternatives more durable. That durability cements the yuan's role and gradually erodes the presumption of dollar universality. Differences among members slow progress, but do not derail it, because the unifying goal of reducing dependency is stronger than the disagreements. What began as symbolic resistance has matured into structural change, carried by the critical mass offered through expansion. Bilateral trade agreements, quiet but powerful. When analysts talk about de-dollarization, the headlines often point to big announcements, summits, press releases, or new blocs declaring their intention to cut reliance on the US currency. Yet the mechanics of change rarely come from those dramatic moments. They come from far quieter moves. Countries sign bilateral trade agreements that by themselves appear routine or even obscure. A commitment to settle commodity trade in local currencies may not spark immediate market shocks, but it establishes precedents. The real story of dollar erosion is found in these fragmented arrangements stitched together across regions. Each deal on its own looks inconsequential. Put them together, and they start to weigh on the system. Consider small energy exporters. A handful of deals between them and China or India that are denominated in yuan or rupees may not alter global benchmarks overnight, but they clearly change habits. Once an exporter receives payment in a non-dollar currency, banks and treasury departments have to adjust their balance sheets. They hold those currencies longer, they arrange swaps or hedges in them, and they become used to operating outside of the dollar system. Multiply this action over dozens of separate arrangements, and the flow becomes visible in currency reserves and trade data. The shift doesn't happen through spectacular announcements. It comes through steady signing of contracts that none of the parties would have thought possible 20 years ago. Agricultural trade deals offer another example. When large importers in Africa or Asia negotiate for grain or soybeans, some suppliers now accommodate requests to settle outside of the dollar. These agreements won't make newspaper front pages because to most readers they look like technical details. Yet behind the scenes, each one represents an incremental adjustment to the dollar-based order. Even small producers, motivated by convenience or political alignment, now accept that invoicing in alternative currencies is feasible. Once in place, reversing the practice is difficult. Traders who once viewed the dollar as non-negotiable begin to view it as optional, and optionality itself is a form of leverage against the old system. In the industrial sector, bilateral agreements increasingly bypass the dollar as well. Countries with strong manufacturing ties, particularly in Asia, have growing networks of trade settled in their own currencies. This reduces transaction costs by avoiding constant conversion and shields them from volatility in dollar exchange rates. The practice looks pragmatic on the surface, businesses economizing, but the cumulative results reinforce the legitimacy of conducting trade without reference to US systems. Factories in one country shipping parts to another, with settlement in local currency, normalize behavior that erodes dollar dominance in ways too subtle to grab headlines. It is not a revolution, but a quiet readjustment, repeated across thousands of shipments. Energy imports offer a clearer lens. When two countries agree to settle oil or natural gas trades in yuan, rubles, or rupees, it chips at one of the most critical pillars of dollar dominance, energy pricing. Major contracts still use the dollar, especially those set on international exchanges. But when smaller exporters and importers test bilateral alternatives, they establish transaction channels, banking procedures, and legal precedents. These structures then exist, even if adoption scales slowly. The channels themselves make future trade in non-dollar currencies easier. Every time another country tests the process, the infrastructure strengthens. Over time, the significance is less about the size of individual trades than the readiness of systems to support expanded use later. The argument against these patterns is that they remain fragmented. No single bilateral agreement presents an existential threat to dollar leadership. The dollar continues to dominate global reserves, global clearing systems, and global benchmarks. The scattered nature of these deals makes them appear like noise rather than trend. Critics argue fragmentation is inherently limited. It cannot replace the system-wide networks built around the dollar. On the surface, this perspective looks justified. The sheer scale of dollar liquidity far exceeds the alternative structures. International corporations still prefer dollar invoicing for efficiency. Without a cohesive alternative network, fragmented deals seem incapable of replacing entrenched habits. But fragmentation has power precisely because it accumulates. The analogy is erosion. A cliff face does not topple from one wave, but from thousands hitting it over years. Each fragment of trade away from the dollar contributes to a cumulative effect that eventually alters structure. If 10 exporters allow settlement in yuan, the difference to global markets is small but measurable. If that number rises to 50 or 100, reserve managers start recalculating exposures. Insurance motives lead banks to diversify, even modestly. That begins showing in official statistics, which investors monitor. Once investors observe the numbers, expectations shift, and expectations themselves spur further diversification. Fragmentation mounts like layers of sediment, gradually reshaping a landscape. Another consequence of bilateral agreements is how they influence domestic perception inside participating countries. When nations see their governments conduct official trade in alternatives to the dollar, local businesses become more willing to request similar arrangements. This internal shift generates fresh demand for non-dollar facilities, bank accounts, swap lines, and payment services. Domestic financial institutions invest in capabilities to support them. Even if the actual volumes remain modest, the institutionalization of these practices prepares the ground for scaling up. What starts as a one-off trade experiment evolves into embedded financial infrastructure that, once built, rarely disappears. This is how small deals echo far beyond their immediate value. The multiplicity of arrangements also insulates participants from political risk. If a country fears that tensions with Washington could threaten its access to dollar-denominated finance, bilateral alternatives act like backup lines. A handful of settlements in local currency may not cover all needs, but they reduce vulnerability. This security motive often drives adoption more than raw economics. Once again, the aggregate impact matters. More countries establishing currency swap lines and non-dollar trade links increases confidence that alternatives can function in emergencies. Once tested, confidence grows. Confidence encourages repetition. The loop reinforces itself quietly, without ever producing dramatic tipping points. Central banks reinforce this dynamic through modest policy. When small portions of reserves are shifted toward partner currencies, the move matches practical needs created by bilateral trade. If an energy contract requires yuan, holding yuan reserves makes sense. That logic expands incrementally. The shifts are tiny compared to dollar holdings, but they integrate seamlessly with trade practices. Reserve managers cite efficiency, businesses cite convenience, policymakers cite independence. Together, they establish legitimacy. Legitimacy builds even if the magnitude remains relatively modest. Over time, legitimacy is what erodes perception of absolute dollar indispensability. The deeper implication is that markets do not require a systemic replacement overnight to alter behavior. They only need credible evidence of alternatives functioning. Bilateral trade agreements provide that evidence in repeatable cases. 20 years ago, most observers would have doubted that significant energy trades could occur outside the dollar. Today, examples exist across continents. Every time another piece of evidence appears, it expands what investors and policymakers consider possible. Once the imagination of alternatives becomes embedded, the stranglehold of inevitability loosens. Fragmented deals create psychological shifts long before they reach systemic scale. The quiet nature of these agreements makes them less visible, but this invisibility is deceptive. Aggregated, they form foundations that persist and expand. For instance, one agreement for agricultural imports may never appear on a chart. 10 of them start to show in statistics. 50 of them shift probability distributions for future forecasts. By the time financial reports reflect measurable change, the groundwork has already been laid years earlier. The decisive point is that by the time markets acknowledge the trend, much of the underlying infrastructure is already in place. The quietness itself masks formative transition. One risk remains clear. Without coordination, these fragmented moves may stall at mid-range adoption levels. Without systemic structures to integrate them, they may always remain secondary to the dollar's network. But even at mid-range, persistent adoption changes the system. It alters negotiations, leverage, and perceptions. The dollar does not need to collapse to lose influence. If enough counterexamples exist globally, political leverage diminishes. That is often the hidden point of these agreements. They reduce dollar dominance not by toppling it directly, but by removing its aura of inevitability. Once inevitability is gone, bargaining positions shift permanently. Seen through this lens, the bilateral agreements scattered across continents form the real story of de-dollarization. They carry modest weight individually, but accumulate into a market force broad enough to show up in reserves and settlement statistics. Their power lies in repetition and accumulation, not in spectacle. The contradiction is that fragmentation and lack of coordination, while limiting, also make the trend harder to reverse. No single policy fix can eliminate hundreds of small channels once established. They persist, adapt, and accumulate. That is why observers describe the erosion of dollar power not as an explosion, but as a process of countless small cuts applied over years. The mini payoff is that the dollar's decline won't come from one giant strike. It comes from many small agreements signed quietly, processed without sensation, repeated until they normalize. The system erodes through a series of quiet cuts, not through a knockout punch. That cumulative effect is what gradually reshapes global finance. Subtle, persistent, and far more difficult to undo than dramatic proclamations suggest. When safe U.S. assets stop looking safe. For decades, U.S. Treasury bonds were treated as the safest investment on the planet. They carried the full backing of the American government, they were deeply liquid, and they came with the expectation that no matter what storms swept through global markets, money parked in treasuries would be protected. The dollar itself carried the same aura, steady, predictable, and widely available. Both assets together formed the bedrock of global finance, a kind of financial shelter that governments, corporations, and individuals relied on in times of trouble. That reputation was not built overnight, but reinforced across decades of crises, where running for safety meant buying treasuries, holding dollars, and waiting until the storm passed. By 2025, though, cracks have begun to form in that reputation, and the behavior of investors shows it plainly. The shift can be seen in the way Treasury yields have moved in the past year. Normally, when global uncertainty rises, investors pour money into treasuries, bidding prices up and pushing yields down. That reliable pattern has been a hallmark of the dollar system since the Second World War. But today, higher volatility in treasuries themselves is unsettling investors. Instead of treating them as a guaranteed safety net, investors are demanding more compensation for holding U.S. debt. Yields drift upward in ways that reflect nervousness rather than enthusiasm. What once signaled refuge now looks riskier. The message is not that America suddenly cannot pay its debts, but that investors no longer treat its bonds as immune to political dysfunction, persistent deficits, or fluctuating inflation expectations. The dollar has followed a similar trajectory. When turmoil spreads, demand for dollars traditionally surges because it anchors global trade and clears transactions quickly. Yet in recent cases of financial stress, flows did not all return to the dollar. Alternative havens attracted attention that would once have gone exclusively to the greenback. Gold, for instance, has seen persistent inflows not only from central banks in emerging markets, but also from large institutional investors. Yuan-denominated swap facilities have grown more frequently used, providing a backdoor for countries looking to hedge without going through dollar markets. Even select European bond markets, the German Bund in particular, absorbed capital that once chased treasuries reflexively. The existence of alternatives is not new, but the willingness of investors to use them in moments of strain shows a change in psychology. Safe no longer means automatic reliance on U.S. assets. This shift matters because perception shapes markets as much as statistics do. If enough investors believe treasuries are less dependable during shocks, they behave differently at the margin. A sovereign wealth fund might allocate a slightly larger chunk to gold instead of dollars, or a central bank might ink a currency swap line with China as insurance rather than increasing treasury holdings. Each isolated decision looks marginal, almost trivial. Accumulated, those decisions reshape flows in the same way small cuts erode a larger surface. The dollar still dominates the structure, but a different pattern in investor psychology creates fragility. Fragility is the quiet companion of trust erosion. It appears slowly, then suddenly affects confidence when pressure builds. The unusual aspect of the recent environment is the way bonds traded when stress increased. Instead of yields tumbling lower as investors sought protection, Treasuries sometimes sold off, creating higher yields at the exact moment they were meant to act as a safe haven. That contradiction alarms participants who had treated U.S. debt like a stabilizer in volatile markets. The volatility undermines the main reason Treasuries were held so widely: predictability. Predictability functions like gravity in global finance, keeping behavior anchored. When gravity looks unreliable, weight shifts elsewhere. Investors do not need catastrophic collapse to reallocate. They only need enough doubt to weaken the certainty. Doubt has shown up in yield movements, and financial systems notice. A humorous way to think about it is that the dollar once played the part of the steady parent in the global household, calm, stable, always there to provide shelter when kids ran inside during a storm. But in 2025, the dollar has started to resemble a moody teenager instead. Sometimes it steps up, other times it slams the door and insists it doesn't feel like helping. Investors expected a rock-solid adult. What they are seeing is mood swings that complicate planning. That unpredictability forces them to diversify. Nobody wants their safety plan depending on an asset that acts capricious when steadiness is what they are paying for. Humor aside, the comparison captures the central theme. Reliability is slipping. The shift in investor behavior often shows up. First, in small things. A fund manager choosing to hedge with more yen or euro exposure. An oil exporter negotiating a yuan settlement line just to keep options open. A central bank nudging a few more tons of gold into reserves rather than adding to treasuries. These minor adjustments may not dominate headlines, but they create a pattern visible in statistics. Market participants take cues from these patterns. If central banks diversify modestly, private firms mimic them, adding weight to the flow. The concept of dollar indispensability becomes softer in practice. Once that softness exists, alternatives gain legitimacy. Legitimacy feeds back into choices, creating incremental change in reserve compositions, swap arrangements, and investment portfolios. It's not only about economics, but also about politics. Investors see the American political system struggle to stabilize fiscal budgets, debate debt ceilings repeatedly, and flirt with government shutdowns. Even when resolved, the spectacle erodes confidence because it demonstrates fragility in governance. Investors understand that the financial capacity of the United States remains unmatched, but they also sense more risk in how that capacity is managed. When money is at stake, perception of competence matters. Treasuries wrapped in political theater lose some of their aura as the neutral, unquestionable asset of the world. That erosion of neutrality makes diversification not only rational but necessary. Gold's resurgence illustrates this theme in the most tangible way. It provides no yield, no cash flows, and little utility beyond a store of value. Yet in the past few years, central banks have added to their holdings at a pace not seen since the 1960s. They do this not just for returns, but as a form of shield against the uncertainty around the dollar and treasuries. Gold cannot default, it carries no political allegiance, and it trades in multiple markets. Its physical nature provides asset holders with an anchor outside the financial system. This appeal translates into real allocations. When measured against the steady erosion in dollar reserve share, gold's rise signals that alternatives considered old-fashioned have become practical again. Other alternatives include direct currency swap lines between countries bypassing New York settlement systems. These arrangements seem technical, but they permit governments to trade without dollar intermediaries, giving them independence in moments where dollar liquidity might dry up or become politically sensitive. Their existence demonstrates tangible diversification. They show up in statistics on reserves and trade financing, reinforcing the narrative that alternatives exist in moments of need. Each example weakens the monopoly of U.S. assets as the only safe place to run when storms appear on the horizon. The broader implication is that the psychological contract that bound investors to U.S. assets is changing. For decades, the logic was binary. When risk rises, buy treasuries, buy dollars, and wait. Today, logic is more conditional. When risk rises, spread allocations, some in treasuries, some in gold, some in other sovereign bonds, and increasingly, some in swap arrangements tied to Asian or Middle Eastern partners. That evolution may sound subtle, but it changes behavior at scale. Binary rules produce certainty. Conditional rules produce fragility. Fragility defines the present shift. Domestic consequences flow directly from this mindset. As foreign demand for treasuries softens, even while yields rise, the U.S. government pays more to borrow. Larger deficits amplify that cost. The more borrowing depends on hesitant investors, the higher the compensation demanded. Those higher yields filter back to households in mortgage rates, credit conditions, and consumer loans. What begins as a shift in foreign investor psychology eventually appears in the interest Americans pay on ordinary debts. Thus, the erosion of safe status for U.S. assets carries consequences beyond global finance, right into family budgets. None of this amounts to a declaration that treasuries or the dollar have lost their place as global leaders. They remain unmatched in size and liquidity. But the era where they were treated as unquestionably safe has ended. Now they are one option among several in the safe haven basket. That subtle shift makes an enormous difference to leverage. The U.S. loses some of the freedom that comes from being the singular destination for nervous money. Competitors gain space, credibility, and fractional power. Incremental erosion in investor psychology generates tangible reductions in America's financial privilege. The mini payoff is clear. The safety blanket of the dollar and treasuries no longer guarantees comfort. Investors still reach for it, but now they keep another blanket nearby: gold, regional swaps, or alternative sovereign bonds, just in case. The trust once singularly attached to American assets is now distributed across a wider set of options. That distribution itself signals the deeper change underway in global finance. When patterns that felt automatic grow conditional, dominance shifts from assumption to question. And once questions persist, the answer is never as secure as before. How much power does China really have? For years, China's massive holdings of U.S. treasuries have been viewed as one of the most important pressure points in the global financial system. After all, Beijing owns a substantial pile of America's debt, and on paper that looks like a lever it could pull at any time to apply pressure in disputes or during heightened geopolitical tension. But in 2025, the picture is more complex. While China still ranks as one of the top foreign creditors of the United States, the size of its holdings has fallen to decade lows. That's not an accident. It reflects a deliberate strategy of reducing exposure to U.S. assets and spreading reserves across a wider range of currencies, gold, and international projects. The decline does not represent an abandonment of treasuries altogether. They still matter for China's financial stability, but it shows a conscious retreat from reliance on one channel. This trend naturally invites the question: could China weaponize its holdings by suddenly dumping treasuries? The image is powerful: Beijing flooding markets with U.S. debt, hammering bond prices, spiking yields, and rattling global investors. It's the kind of scenario that excites headlines and alarms policymakers. Yet when you look closely, the feasibility collapses quickly. Selling off massive amounts of treasuries would not just punish Washington, it would punish Beijing too. The prices of the securities China already owns would plummet, eroding the value of its balance sheet. More importantly, such an act would undermine the very stability of the dollar system on which China still depends. Even if Beijing aims to internationalize the yuan, it cannot risk detonating the global system that sustains its export markets, investment inflows, and the security of its reserves. The weapon looks powerful until you realize pulling the trigger involves shooting yourself in the foot. Another factor is credibility. Global investors would interpret a sudden sell-off as sabotage. Even allies of Beijing might question whether a government willing to destabilize such a crucial market could be trusted with their own financial interests. That doubt would damage China's ambitions to promote the yuan as a stable international currency. Reserve status is built on trust above all else. If China undermines trust in U.S. assets through hostile actions, it risks undermining trust in its own currency even more. That reputational cost outweighs the temporary leverage a treasury sell-off might provide. Beijing knows this and acts accordingly. The risk is that threats are sometimes misread as actual plans, but the practical incentive works in the opposite direction. China gains symbolic leverage by allowing the possibility of dumping treasuries to exist in imagination, while avoiding the devastating costs of following through. The reality is that Beijing has pursued a diversification strategy rather than a showdown strategy. Step by step, it has reduced its proportion of reserves sitting in treasuries, reallocating toward gold, sovereign bonds and other currencies, and direct investments through state-backed infrastructure programs overseas. The effect of this diversification is important. It signals to markets that China is no longer comfortable keeping such a high concentration of wealth tied to the decisions of the U.S. Congress or the Federal Reserve. But the method of exit is gradual, calculated, and designed not to disrupt markets violently. As a result, no panic erupts when holdings fall. Traders and analysts watch the reductions and note the direction, but they do not interpret them as hostile acts. They read them as prudent portfolio management, even if the political undertone is clear. The symbolic power, however, should not be understated. Even without wielding the weapon, China's Treasuries portfolio is often mentioned whenever tensions rise. The perception that Beijing could release a flood of U.S. debt hangs in the background of diplomatic disputes. That perception itself adds to China's bargaining weight. In negotiations, leverage doesn't always depend on action. It often depends on what the other side fears you might do. Washington understands that sudden market moves, even partial, could rattle investor confidence quickly. This knowledge means China doesn't need to act at all. Just holding the option in theory amplifies its influence. It turns passive ownership into a psychological tool. Yet the irony is that the tool works best when used. As soon as the weapon is fired, its credibility and value diminish. In addition, global markets have grown used to fluctuations in China's treasury holdings. Each year, analysts track whether the portfolio rises or falls by tens of billions of dollars. It has become a kind of barometer for relations between Beijing and Washington. But seasoned investors know that the system is too intertwined to make complete disengagement feasible. The U.S. needs foreign creditors to absorb part of its debt issuance, and China, with its large surplus, needs safe and liquid storage for its earnings. While the balance between these needs may shift, the structural relationship endures. In many ways, the interdependence defines why neither side can fully weaponize the connection without severe self-inflicted damage. It's also worth noting that in raw numbers, even at decade lows, China's holdings remain large by any standard outside America's unique scale. Moving that much capital into alternative assets is not a trivial exercise. Gold markets, for instance, cannot absorb the entirety of such flows without massive distortions in price. Other sovereign bond markets lack the depth to accommodate the diversification easily. Expanding direct investments brings political risks if host countries grow suspicious of China's motives. These constraints mean treasuries, despite reduced attraction, still play a necessary role in the management of China's reserves. The balance that emerges is less about total rejection and more about pragmatic reallocation alongside continued reliance. Washington remains a debtor to China, and China remains a creditor to Washington, even if the composition changes over time. Speculation about weaponization often spikes during moments of tension, in trade disputes over Taiwan or during sanctions debates. The storyline appears clear. China could retaliate by hammering the treasury market, but historical evidence shows restraint. During past disputes, holdings shifted slowly, not dramatically. Rhetoric may grow louder, yet execution sticks to gradual diversification. The difference between language and action reflects a calculation grounded in self-interest. Stability trumps symbolic strikes. Beijing's financial managers understand that the costs of destabilization would outweigh the diplomatic message. This is why each time the scenario arises, it remains more theory than practice. Analysts discuss it, headlines amplify it, but the market reality shows continuity rather than chaos. The deeper story is what China is trying to build with its gradual adjustments. By spreading holdings across currencies, commodities, and projects, it is constructing a buffer against dependence on a single point of risk. This buffer highlights the strategic aim, not to destroy the dollar system instantly, but to prepare for a world where alternatives exist if dollar dominance erodes naturally. Diversification is preparation, not an attack. It makes China less vulnerable without forcing the confrontation that a sudden dump of U.S. assets would provoke. Diversification also gives Beijing credibility when encouraging other countries to shift. It can point to its own reserve management as proof that alternatives are workable. That credibility supports broader ambitions for the yuan and for financial independence. Still, symbolic leverage has political effects. American policymakers remain aware of the headline risk attached to China reducing its holdings. Even if markets don't collapse, announcements can trigger spikes in yields or dips in confidence. For Washington, those signals suggest vulnerability. For Beijing, they represent an inexpensive way to remind the United States that interdependence cuts both ways. Nobody expects the bond market to implode because of Beijing's actions, but the lingering fear acts as a soft constraint. It injects caution into U.S. decision-making. The fact that this restraint stems from perception rather than action demonstrates the potency of symbolic power. What emerges by 2025 is a balance between myth and reality. In reality, China cannot and will not deploy Treasury sales as a catastrophic weapon. The damage to its own finances and credibility would be too severe. In myth, the mere possibility functions as leverage, referenced in debates, highlighted in analysis, and understood in Washington as one more variable to consider. The blend of myth and reality creates the space where China operates. Its actual power lies not in dumping securities, but in the psychological weight of knowing it could sell more if conflict deepens. As long as that possibility exists, the narrative of leverage persists. The mini payoff here is clear. China's Treasury holdings give it symbolic weight, not the power to collapse the system unchallenged. The strategy it follows is diversification, not detonation. By reducing exposure gradually and spreading reserves into alternatives, Beijing hedges against risk while preserving stability. The idea that it could weaponize its holdings is useful mostly as theater. In practical terms, China's financial clout works best as a shadow hanging in the background, not as a hammer, waiting to fall. Digital currencies, the new frontline. Central bank digital currencies are no longer speculative experiments taking place in obscure policy papers. By 2025, they have emerged as practical tools being used in select cases to reshape how countries settle trade and cross-border payments. The logic is simple. If you can digitize your national currency with government backing, you can cut out intermediaries, settle transactions faster, and potentially reduce reliance on older financial networks rooted in the dollar system. That combination makes digital currencies attractive for governments seeking more control and for countries that want alternatives to U.S.-centric settlement pathways. What makes this development striking is that it comes not through markets evolving naturally, but through central banks deliberately building new systems from the ground up. China is the most advanced in this race. Its digital yuan, often referred to as the ECNY, has moved well beyond pilot programs. Domestic use is routine in major cities, but the frontier now is cross-border trade. Select international partners have started accepting and using the ECNY to settle official contracts. This step, modest as it may look in scale, demonstrates that the infrastructure exists to conduct international trade without passing through the dollar system at all. The system functions on government-backed blockchain technology, allowing direct clearing from one central bank to another without waiting on U.S. clearinghouses to sit in the middle. For Beijing, each of these international uses signals progress in building the legitimacy of its currency at the global level. For participating countries, it presents faster and potentially cheaper ways to do business, all while diversifying away from reliance on the dollar. The ECNY's advance does not mean it is anywhere near replacing broad use of the dollar, but the symbolism carries weight. For decades, changing the currency of settlement in any large trade was complicated, costly, and politically risky. Now, with central banks directly building infrastructure, those barriers decline. Technology provides a means to sidestep structures that once seemed immovable. A small economy trading with China through ECNY is no longer a theoretical rebellion against the dollar system. It is a plug-and-play option within newly constructed digital networks. Perception matters here. Once governments see that cross-border flows can occur smoothly in digital form, they become more comfortable exploring alternatives more often. Confidence builds on repetition, and China is supplying the infrastructure that makes repetition easy. Contrast this with the United States, where progress on a digital dollar has moved slowly. The Federal Reserve has discussed the possibilities, issued consultation papers, and tested models in limited form, but no broad program exists. In public communications, officials emphasize caution, privacy, and the need for congressional approval before any launch. That deliberative pace reflects a kind of institutional inertia. The United States, sitting on the current dominant currency, has the least incentive to rush change. Its payment and settlement networks already give it influence. Adopting a radical new structure could threaten that advantage. So while China accelerates, Washington hesitates. This divergence raises questions about whether being cautious is prudent or whether it risks ceding future ground. The implications are visible in how smaller economies behave. Countries that trade heavily with China increasingly open themselves to experimenting with digital yuan settlements simply because the system exists. Convenience and economic pragmatism invite engagement. For these governments, waiting on Washington to eventually decide on a digital dollar is less attractive than using tools already available. The early mover advantage is clear. By setting standards, building networks, and demonstrating real use cases, China positions itself as the reference point for digital settlement. Even if the dollar remains dominant, lack of activity on the digital front leaves it reactionary rather than leading. The missed opportunity is symbolic but also practical. Once pipelines are built and habits are formed, reversing them is difficult. Yet central bank digital currencies are not simply neutral tools. They carry with them debates about privacy, control, and sovereignty. A government-issued digital currency gives central banks and financial authorities far more visibility into transactions than traditional cash or even ordinary electronic payments. For authoritarian systems, that visibility aligns with existing practices of state monitoring. For democracies, it raises alarms over how much control government should have over individual financial lives. If every purchase, transfer, and holding is logged in state records, the potential for abuse grows. Citizens worry about surveillance, about political filtering of access, and about the risk of overreach. These concerns have slowed adoption in some places, even as the technology advances rapidly. The tension lies in balancing efficiency against control. Digital currencies promise reduced settlement times, lower transaction costs, and independence from foreign clearing systems. At the same time, they risk introducing what critics describe as state-level financial micromanagement. Imagine a system where government can freeze funds instantly, restrict purchases, or direct spending toward approved purposes. That kind of programmable money appeals to policymakers interested in agility during crises, but it unnerves populations accustomed to autonomy. As a result, debates about digital currencies are as much about politics as they are about technology. Different societies will weigh those trade-offs differently, creating a fragmented global landscape in which adoption patterns reflect political culture along with financial logic. China views this trade-off through its own lens. For Beijing, the ability to monitor flows and prevent capital flight is a feature, not a bug. In fact, one of the central problems with yuan internationalization historically has been limited capital freedom. Adding the ECNY provides authorities with more confidence that they can expand international usage without losing control domestically. They know that every transaction is visible and managed. For foreign governments, that assurance that China is firmly behind and monitoring the system can be reassuring in one way: it will remain stable. Yet critics see that stability as smothering innovation and suppressing autonomy. The same feature can be interpreted as strength or as weakness, depending on perspective. The United States, in contrast, struggles more openly with political pushback. Privacy advocates worry about surveillance if a digital dollar is introduced. Banks worry about disruption to their role in deposits and payments. Lawmakers hesitate to endorse a change that may be unpopular with constituents. These pressures slow the timeline. America's financial institutions already profit from serving as intermediaries in dollar payments across the globe. To replace or disrupt that with a central bank system that potentially sidelines them risks huge industry opposition. That combination of political concern and corporate lobbying contributes to the delay. Meanwhile, technology continues to advance. Cross-border pilots using digital yuan with countries in Asia, the Middle East, and Africa have shown that the digital option functions efficiently. These transactions are small in the context of global trade, but they are proof of concept. Once proven, they tend to expand. Networks grow not linearly, but exponentially when early adopters succeed and encourage others. The precedent of using a federal digital ledger to clear international trade changes expectations about what is possible. What makes this especially consequential is that technological pathways often move faster than geopolitical decisions. Political reshaping of the global monetary system could take decades, but technology can introduce usable alternatives much sooner. If enough governments find that digital settlement through systems like ECNY lowers their costs and avoids risks tied to sanctions or volatility, adoption accelerates. The practical incentive to use what works can move faster than philosophical commitment to dollar dominance. That is why central bank digital currencies represent a front line that may accelerate change more effectively than speeches, agreements, or formal blocks. At the same time, CBDCs magnify the central question of trust. Currency systems ultimately succeed because people and governments trust that they work, remain stable, and protect value. For China, building trust around the ECNY is a challenge precisely because of its governance model. For the US, trust in the dollar remains strong, but delays in modernizing technology risk portraying it as complacent. The dynamic may shape future currency alignments not through dramatic collapse or replacement, but through steady preference for systems that feel modern, efficient, and secure. The mini payoff here is that technology may move faster than politics. Geopolitical debates about reserve currencies still matter, but digital currencies offer an accelerant that bypasses those debates and focuses on practical utility. If governments and central banks discover these tools lower costs, speed trade, and give them more autonomy, adoption builds momentum on its own. In that environment, the erosion of the dollar's singular hold may not come only from strategic rivalries or policy missteps. It may come from the simple fact that a new technological option exists and works better for enough people. Once momentum passes that point, the system changes not because of ideology, but because users follow efficiency. How everyday Americans actually feel the shift. For most Americans, the talk about reserve currencies and central banks sounds like something that belongs in graduate seminars or long reports buried in finance departments. But the truth is, changes in how the dollar is used worldwide don't stay confined to economics textbooks. They land directly in everyday budgets. The challenge is that the link is indirect, so most people don't notice it until the effects stack up. That invisible chain, global confidence in the dollar feeding into borrowing costs, trade balances, and price tags, is what makes the conversation relevant at the grocery store, not just on trading desks. By 2025, those connections are gradually becoming visible to households, even if the terminology still feels abstract. One clear example is imported goods. America runs persistent trade deficits, meaning it imports more than it exports. In practice, that gap is smoothed by the dollar's reserve role. Foreign sellers take American currency without question and reinvest it into U.S. assets, recycling the flows. As long as that faith remains strong, the cycle continues smoothly. But when other countries diversify away and transact in non-dollar currencies, the loop starts to thin out. That makes imports more expensive in dollar terms, because the ease of settlement is reduced and the currency itself feels marginally weaker. For households, it shows up as higher prices on everyday foreign-made goods, TVs, phones, cars, and appliances. Even the smaller items we barely think about, the coffee beans in Starbucks lattes, the bananas in the morning smoothie, depend on trade denominated in dollars. If suppliers demand stronger compensation because the dollar doesn't stretch as far, the cost passes through. That process leaves consumers paying more without ever hearing the word de-dollarization on their receipts. People already feel strain from inflation that has lingered well above the levels of the last decade. When the dollar weakens in relative terms, it adds another layer. Inflation doesn't just come from too much domestic spending, it also comes from international purchases that now cost more in dollar terms. Families notice it not by reading IMF reports, but by seeing the difference at checkout lines that never return to cheaper norms. An imported iPhone goes from affordable to premium. A dinner table with more imported ingredients grows more expensive meal by meal. Clothes manufactured overseas arrive with higher price tags. These subtle pressures clump together into a wider sense that money doesn't go as far as it used to, even when wages haven't adjusted upward in equal measure. At the heart of this is America's persistent trade deficit acting as an invisible engine of higher costs. Decades of buying more from overseas than selling to it has been manageable only because the dollar's demand kept that balance sheet sustainable. The ability to finance large deficits cheaply is what allowed Americans to absorb imported goods at lower consumer prices. That long-term subsidy weakens as global participants normalize other currencies. If America still runs trade deficits, but recycling grows weaker, the country pays more to cover the gap. At the household scale, This isn't seen as trade imbalance. It's experienced as groceries rising week by week, cars creeping up in price each new model year, or electronics edging toward luxury classification rather than mass affordability. Humor helps explain how even small conveniences are wrapped up in dollar privilege. Think about your Starbucks latte. The milk might come from domestic farms, but the coffee beans in your cup probably traveled across borders before reaching your neighborhood shop. The price you pay relies on contracts and exporters willing to exchange beans for dollars without hesitation. If that willingness slows, costs shift upward. Suddenly, your daily caffeine becomes an indirect casualty of a weaker reserve currency position. It's not international politics you taste. It's a stronger hit to your wallet while sipping what used to feel like an affordable routine. The same logic applies to electronics, clothing, and even fuel. Small splurges morph into symbols of shrinking purchasing power, carried quietly by a dollar that no longer commands the same reach. The challenge, of course, is that financial debate in elite circles sounds irrelevant to most families. Average households do not instinctively connect Senate hearings on fiscal deficits or central bank reports on global reserves with the cost of debt on their credit cards. Yet the mechanics draw those elements straight into their budget lines. When foreign buyers demand higher yields for treasuries because they see more risk, America's borrowing costs rise. When government borrowing is more expensive, overall interest rates tend to remain elevated. Households then face mortgages that stay costly, car loans that swallow more income, and credit cards that accumulate heavier balances. The fact that stadiums filled with economists debate reserve status is irrelevant in tone but central in impact. The debates may feel like ivory tower exercises, but they craft the conditions around which ordinary people refinance their homes or approve a new loan. Another area where erosion appears quietly is in wages and employment. A weaker dollar increases import costs, which pressures inflation, which prompts the Federal Reserve to maintain higher interest rates. Those higher rates place weight on borrowing for businesses. Expansion slows, investments shrink, and jobs don't open as quickly as they might have done under cheaper credit. Workers feel the difference as fewer opportunities, slower wage growth, or less security in volatile industries. Again, the story is not branded currency decline in media headlines, but the financial machinery underneath it is shaped by how central banks worldwide allocate reserves and what confidence flows into or drifts away from the dollar. For everyday careers, that sets the background against which people negotiate salaries, hunt for jobs, or evaluate stability. Psychology also operates as an invisible hand on consumers. If news cycles amplify concern about dollar weakness and global diversification, the perception itself can affect how households think about their money. People become more cautious, saving cautiously, adjusting spending, or turning to hard assets like houses and gold if they believe currency power is declining. That defensive behavior then reinforces economic slowdown. Fear, even in modest doses, alters markets. Households combine vague memories of headlines with concrete feelings of higher costs, blending into an outlook that feels uncertain. Uncertainty itself carries a price when consumers or businesses hesitate instead of investing confidently. Debt levels reinforce the cycle. America carries large public debts that require rolling over into global capital markets. If participation weakens or demands higher compensation through yields, the cost of servicing debt expands. Taxpayers cover those costs over time, reducing the funds available for public services or pushing future tax burdens higher. That redistribution of resources filters into everything from healthcare systems to infrastructure maintenance. Families feel it not through hearing about yield premiums, but through higher taxes or less generous services. Again, abstract finance morphs into a direct household consequence. Crucially, it is the subtle nature of the process that explains both why ordinary people often ignore it and why economists find it so significant. A collapse grabs attention, but slow erosion embeds itself in ordinary costs where nobody connects the dots. By 2025, ordinary Americans already live inside this environment: steadily rising import prices, stubborn interest rates, heavier credit conditions, without ever framing it as the consequence of dollar decline. They simply describe it as things getting more expensive. That is the household translation of a global story unfolding above their heads. The point of tension is clear. Households cannot see the connection between reserve ratios and their grocery list. Elites discuss global shifts as strategy and projection. Families operate only in the present tense of bills and wages. That disconnect creates frustration. Debates sound abstract, solutions far away, while the pain is immediate. Addressing that gap is one of the biggest challenges for policymakers, because if regular citizens don't believe the debate applies to them, political appetite for reform shrinks. But ignoring the chain doesn't make the effects vanish. It simply leaves everyday Americans absorbing costs quietly. The mini payoff here is straightforward. You don't need a finance degree to witness the decline of dollar privilege. It is already visible in subtle but unmistakable ways. Higher price tags on imported goods, more expensive debt payments, slower wage growth. The conversation in global finance rooms echoes directly into household budgets across America. People may never use the terms reserve status or de-dollarization, but they are already paying the bill written by those trends every time they reach for their wallet. How soon could this really happen? When people hear about countries settling more trade in yuan or reserves moving slightly out of dollars, the natural question that follows is, how soon does this actually flip? The most common fear is that the dollar is hanging on by a thread and that a collapse could come without warning. That fear shows up on social media, in opinion columns, and even in daily conversations when inflation rises and people look for explanations. Yet when you study the history of reserve currencies, the overwhelming pattern is that leadership takes decades to shift, not years. Sudden crashes make for dramatic headlines, but the reality has always been much slower. That's an important distinction, because if the dollar is losing ground, it's not vanishing tomorrow morning. It is leaking share gradually, which still matters, but in very different ways than the word collapse suggests. The pound sterling offers one of the clearest examples of gradual decline. Even as Britain's economic power peaked in the late 19th century, the pound remained the central currency of global trade and finance. After World War I weakened Britain's fiscal position, and especially after World War II, when the United States emerged as the economic giant, the dollar started displacing the pound. Yet through the 1950s and even into the 1960s, many central banks held significant reserves in sterling. Finance is sticky. Relationships, networks, and habits do not turn on a dime. The pound lived on as a meaningful reserve long after its empire receded. That precedent shows how inertia prolongs usage far beyond the moment of economic decline. The same mechanism will almost certainly slow any decline of the dollar. Forecasts vary, but most place the dollar as the majority reserve currency for decades to come, even if its share keeps slipping a few percentage points at a time. The slope matters more than the level. If the dollar slides from, for example, around 3/5 of global reserves toward just above half, that's still dominance, but it forces investors to think differently about the future. Analysts often stress the word path rather than point. The United States may well remain the main anchor currency into mid-century, but the advantage once seen as eternal is now visibly narrowing. While that trajectory doesn't scream tomorrow's collapse, it does whisper something more sobering. Adjustment is underway, and it compounds year by year. The tension lies in the mismatch between how finance evolves and how people perceive it. Media feeds hype sudden breaks because they're easier to dramatize. Saying the dollar collapsed grabs more attention than saying it may lose 1 percentage point of reserve share each year. But compounding erosion, while boring to headline writers, can achieve far more over time. The fear of collapse tomorrow creates anxiety far greater than warranted, while the reality of gradual erosion poses risks that are arguably more consequential in the long run. Individuals tune in expecting disaster, but what they confront instead is a slow bleed that changes conditions steadily without ever offering a single date to circle on a calendar. That difference often leaves the public confused, and confusion itself undermines confidence. Economists who study these cycles point to generational timelines. It often takes between 30 and 60 years for a reserve currency to fully yield its dominance to another. That stretch is important because it allows investors to adapt in markets to develop the infrastructure necessary to handle alternatives. Without liquid markets, deep bond issuance, and legal protections, a currency cannot simply flip into dominant status. The operational backbone of global finance requires time to build, and the United States, with its deep treasury market and established clearing systems, holds an edge that others cannot replicate overnight. This inertia locks the dollar into its position, even as others nibble at the edges. In practice, that means the dollar's decline will be measured not in months, but in decades. That historical cadence contrasts sharply with how ordinary people expect change. Someone reading a headline about Chinese oil purchases in yuan might assume a domino effect ending the dollar's reign is imminent. The leap is understandable, but the causality is slower. One trade agreement establishes precedent, dozens build habit, hundreds shift perception. Only then does the balance in reserves tilt materially. The process resembles erosion of rock, rather than toppling of a wall. Every cut matters, but the wall still stands for a long time. This difference between visible anecdotes and invisible statistics feeds anxiety in the public imagination. Hearing about the end of the dollar makes for a gripping podcast title. Living through a reduced share of reserves that slowly increases borrowing costs feels less cinematic, but has real impact over years. This mismatch between narrative and reality creates unnecessary fear. Instead of preparing calmly for long-term adjustment, people sometimes panic, thinking all value tied to the dollar will collapse imminently. That panic can drive unwise financial choices, from overbuying gold to dumping investments irrationally. The sober truth is that the system does not support sudden death spirals because too many participants still rely on the dollar infrastructure. Everything from global shipping invoices to central bank swap lines depends on it. The scale and entanglement create stability even when sentiment weakens. Other currencies are advancing, but none are ready to assume full leadership instantly. Multipolar finance takes time to organize, and while that happens, the dollar retains a default leadership role by virtue of scale and habit. This is not to say the United States has nothing to worry about. A slow bleed is still a wound. Losing 2 or 3 percentage points of reserve share over a few years sounds minor, until you realize that trend extended over a generation could reduce dollar dominance from commanding majority to contested plurality. That reduction reduces leverage. Borrowing costs go up, sanctions lose bite, trade influence diminishes. Each of those carries domestic consequences in wages, prices, and fiscal balances. So while collapse is unlikely anytime soon, complacency is also dangerous. The safe framing is that decline is not immediate, but very real in cumulative effect. People can overreact to an imagined crash, but they can also underreact to slow erosion. Both carry consequences. When forecasts are laid out, you see broad convergence on this reality. Analysts model central bank allocations and project steady erosion under different interest rate conditions. Some assume sharper acceleration if deficits continue at current pace. Others allow for stabilization if fiscal reform or major innovation restores confidence. But in every case, the assumption is that change plays out over decades. You rarely see serious research pointing to the dollar losing majority status within 5 years. More commonly, the horizon extends to 30 or 40 years to even imagine parity between the dollar and its nearest competitors. The reason is simple. Institutional memory resists radical shifts, and building the necessary depth for alternatives takes time. The public perception that tomorrow might bring sudden collapse owes more to headline dramatization than to historical patterns. You encounter the claim often in periods of economic stress, high inflation, political turmoil, or currency fluctuations. Yet those episodes almost never trigger immediate structural replacement. Instead, they encourage diversification, hedging, or experimental agreements. Those behaviors accumulate into meaningful change, but the change takes years. The British pound did not collapse the moment US GDP overtook the UK's, nor did Dutch influence vanish the day Britain raised its first steam engine. Finance clings to structures long after economics signal decline. The United States enjoys that same inertia, giving it time to adapt if policies are adjusted wisely. Without reform, the erosion compounds, but the time horizon is too long for collapse narratives to be credible. The timeline matters most because it shapes how households interpret risks. If you believe collapse is tomorrow, panic follows. If you understand that erosion is gradual, you can prepare carefully, hedging without overreacting. Investors diversify, households adjust spending, policymakers debate reforms, all within the recognition that nothing crashes overnight. The discipline comes from viewing decline as chronic, not acute. Chronic illness requires management, not emergency surgery. The dollar's status falls in that category. It is weakening, but it still controls massive networks that buffer it. Managing the chronic condition means reducing deficits, reinforcing trust, and balancing innovation against inertia. The reality check for viewers is straightforward. If you wake up tomorrow expecting the dollar to be replaced as the central reserve, you'll be waiting a long time. These systems shift at speeds measured in decades, not news cycles. But acknowledging the timeline does not mean ignoring the trend. Year by year, the numbers confirm gradual leakage, and leakage over time shapes borrowing costs, trade dynamics, and household budgets. The pressure builds so slowly that it is easy to dismiss. Yet pressure sustained becomes defining. The mini payoff is reassuring. This isn't a headline you'll see tomorrow morning about sudden collapse. It is instead a theme that creeps forward little by little, compounding until it becomes obvious. For households, that means no need to panic overnight, but plenty of reason to pay attention. The knowledge that change is gradual provides calm, but the recognition that change is real provides purpose. Taken together, these insights allow people to relax about crisis narratives while still understanding the adjustments underway in the background of their daily lives. The U.S. playbook. Can Washington respond? If the dollar is slipping, the natural question becomes what policymakers in Washington can actually do about it. The menu of choices is familiar on paper. Bring deficits under control, modernize the financial system with a digital dollar, and use trade diplomacy to rebuild confidence in American markets. But while the toolkit looks straightforward, the politics surrounding each option make the execution messy. The contradiction is clear. America remains intent on maintaining global dominance, yet it resists the domestic sacrifices that come with making its currency durable in the long run. That mismatch is precisely why many analysts warn that even modest erosion in the dollar's standing could accelerate if Washington fails to act. Start with deficits. America's fiscal imbalance has become one of the largest points of pressure. The government spends far more than it collects, and filling that gap requires constant issuance of new debt. For decades, foreigners happily absorbed those bonds, recycling their surpluses into treasuries. The cycle worked because the dollar was seen as the safest, deepest, and most liquid market on Earth. In 2025, however, the bill is heavier. Interest payments eat a larger share of federal outlays, and investors are more cautious than they once were. The simplest way to restore confidence would be to reduce borrowing, a combination of spending cuts or tax adjustments to signal that debt will not spiral unchecked. But here lies the contradiction. The public appetite for austerity is low, and politicians face near constant incentives to boost spending rather than cut it. Campaign promises focus on benefits delivered, not on bills restrained. That political inertia means the obvious lever, deficit reduction, remains more a talking point than a reality. The result is a system where everyone knows the medicine, but no one wants the dose. Policymakers float proposals to trim programs or raise revenues, yet bipartisan consensus rarely forms. Without clear action, debt levels keep climbing, and foreign creditors watch with unease. In an environment where central banks are already diversifying, hesitation in Washington reinforces the perception of complacency. The tension here is not economic theory. Economists of every stripe agree lower deficits would help, but political paralysis. Parties score points by blaming each other for spending, but neither accepts the cost of real change. This is where the cycle of inaction amplifies risk, because markets perceive that the United States knows the problem but refuses to solve it. Another lever available is financial modernization through a digital dollar. Other nations are already experimenting with central bank digital currencies, and China in particular has begun extending the ECNY into international pilot programs. A U.S. digital dollar would not instantly settle the question of reserve status, but it would signal that America intends to remain at the front of financial infrastructure. It would guarantee that even as settlement technology evolves, the dollar keeps its central role. Yet Washington has been slow to act, citing privacy concerns, risks to the banking sector, and political unease about government control. The Federal Reserve has researched options but avoided commitment. A digital dollar would also require congressional input, a process riddled with lobbying and skepticism. Commercial banks worry about being cut out if the public can store money directly at the central bank. Privacy advocates worry about surveillance. Lawmakers hesitate to approve a tool their voters may not understand. In effect, the biggest impediment is not technical ability. The U.S. certainly has the capacity to build such infrastructure, but governance hesitancy. Each year of delay cedes early mover advantage to others. The message, once again, reinforces doubts. America talks about leadership in finance, but drags its feet when new tools arise. For reserve managers abroad, this hesitancy echoes in their diversification strategies. They hedge by trying new systems available now rather than waiting for the digital dollar that might arrive someday. Trade policy forms the third lever. For much of the post-war period, America anchored large trade agreements, set the rules of global commerce, and benefited from near-universal adoption of the dollar in transactions. In recent years, the pattern has changed. Washington has prioritized tariffs and confrontational negotiation tactics, rather than the consensus building that used to characterize its economic diplomacy. That shift creates openings for rivals. China, through the Belt and Road Network and direct bilateral deals, fills gaps once occupied by U.S. leadership. Each new agreement closed outside the dollar framework builds habits that reduce reliance on American channels. For the U.S. to counter this, a return to active trade diplomacy is required, offering partners new deals, opening markets, and reaffirming the dollar's convenience as the settlement medium. Yet here again, politics complicates action. Domestic industries push against broader trade liberalization, fearing competition. Politicians campaign on protecting jobs, not signing multinational compacts that sound abstract to voters. The contradiction is sharp. America desires global financial dominance, but often resists the globalization that sustains it. By turning inward economically, it erodes the very foundation that keeps the dollar useful abroad. Without trade growth, the circulation of the dollar abroad diminishes, and alternatives creep in to fill the void. Restoring diplomacy would not require grand breakthroughs, but it would demand consistency and reliability in America's commitments. Even small steps, new bilateral agreements, regional compacts, could reinforce the habit of dollar settlement. The pathway is available, but political appetite is limited. The central theme cutting through all options is paralysis. Policymakers know the risks posed by debt, technology gaps, and slipping trade leadership. The levers exist to address them, but actually pulling those levers requires political will that has been scarce. Dysfunction in Congress, short-term election cycles, and partisan rivalry combine to prevent the kind of long-term strategy reserve dominance demands. While America debates, others act. That delay does not spell immediate collapse, but it does accelerate erosion. Confidence dwindles not because the U.S. lacks strength, but because it fails to apply its strength decisively. Even with these limitations, the picture is not all grim. Markets respond strongly to even modest reassurances. A credible framework for deficit reduction, even if phased slowly, would steady bond markets. A concrete announcement about pilot programs for a digital dollar would remind investors that America still sets standards rather than follows them. Trade diplomacy, even if modest, could restore predictability to partners and reaffirm the dollar as the simplest choice for global commerce. None of these actions requires heroic overhaul. They require incremental, consistent signaling that the U.S. is managing its responsibilities seriously. The scale of the dollar system is so large that even small reforms reverberate globally. This is why many analysts argue the decline is not inevitable. The erosion visible in reserve statistics is real, but its continuation depends on whether America chooses paralysis or response. If Washington demonstrates discipline, even in modest doses, the dollar could maintain its leadership position for decades. The strength is still inherent. The markets remain deep, liquidity unmatched, and trust largely intact. But those strengths are conditional. They require reinforcement through credible policies. Acting too late risks letting alternatives gain traction irreversibly. Acting early, even in partial form, buys time. Time in this context is power, because as long as the dollar keeps majority share, every year prolongs habit, and habit is one of the strongest forces in finance. The risk is not that the U.S. lacks the tools to defend dollar dominance. The risk is that politics prevent those tools from being used until the erosion has gone so far it cannot be reversed. History shows that reserve currencies decline most quickly not when rivals surpass them, but when the dominant nation fails to manage its own house. The irony is that for America, the solutions are known, and the obstacles are self-imposed. Fiscal reform, modernization, diplomacy, each is within reach. What remains uncertain is whether the political system can overcome gridlock long enough to apply them. The mini payoff here is the recognition that decline is not destiny. Washington has levers that, if used responsibly, could protect the dollar's role for many decades to come. Political paralysis makes the path uncertain, but the structure of global finance still bends in America's favor if stability returns. The reserve status is not set in stone, but neither is its loss preordained. It hinges on choices that, if made wisely, can keep the dollar dominant far longer than the current wave of pessimism suggests. A silent player, the euro's position. When the discussion about the dollar's future comes up, attention usually swings straight to China and the yuan. That focus makes sense given Beijing's deliberate strategy, but it also hides a quieter reality. The euro, without dramatic speeches or rapid policy campaigns, sits firmly in the picture. Roughly 1/5 of the world's foreign exchange reserves remain denominated in euros. That means central banks are not just experimenting with it, but holding it in amounts large enough to matter in stability terms. The euro does not generate the same excitement as the yuan, nor the same drama in headlines, but its presence is a reminder that de-dollarization is not a single-track contest. The United States faces a spectrum of challengers, and among them, Europe continues to occupy a steady position. Conditions under which the euro could reclaim more influence hinge on structural questions about the eurozone itself. The currency's architecture is unusual. It represents 19 governments tied into one monetary unit, coordinated by the European Central Bank. This design creates both strength and fragility. On one hand, it pools together the economic weight of Europe as a bloc, giving scale to a currency that might otherwise be fragmented nation by nation. On the other, it means that financial credibility for the euro depends not on a single government's discipline, but on collective cohesion. Confidence in the euro therefore rises when the bloc appears politically and fiscally unified, and it weakens whenever internal disputes erupt. For the euro to claim more ground in global reserves, greater unity over fiscal management and decision-making would be needed. Consider how the euro gained strength in its first decade. After its launch in 1999, foreign central banks moved rapidly to add it to their reserves, attracted by the prospect of a stable, liquid, and large market that combined France, Germany, Italy, and others under one system. The momentum slowed during the sovereign debt crisis of the early 2010s. At that time, the prospect of countries like Greece or Italy leaving the currency union shook confidence worldwide. Reserves dipped, and the euro's trajectory toward becoming a co-equal with the dollar stalled. The lesson for analysts was simple. The euro has the scale to remain a major player, but its credibility directly ties to European political harmony. Without steady coordination, investors remain hesitant to make it their first choice. In 2025, that challenge persists. The eurozone has weathered major crises, including the pandemic and energy shocks, without disintegration. Its currency still represents about 1/5 of reserves, a far larger share than the yuan and other emerging challengers. Yet its limitations remain embedded in its politics. Europe has not moved toward a unified fiscal authority in the same way it built a centralized monetary authority. That absence means bond markets remain fragmented by national government, with German bonds viewed as safer than Italian or Spanish debt. Global investors seeking a true replacement for treasuries do not find an equivalent. For the euro to claim a larger role, deeper integration of sovereign debt markets would be needed. That would allow Europe to issue bonds with similar liquidity and depth as the US Treasury, giving reserve managers a more compelling alternative. The tension here is structural. Europe knows what reforms would boost the euro's standing: closer fiscal union, expansion of common debt instruments, and consistent policy signals. But each requires political agreement across multiple governments with different priorities and electoral pressures. German voters remain hesitant to share fiscal risk with Southern Europe. French leaders support integration, but face domestic resistance. Smaller economies value their autonomy. These political constraints explain why the euro has plateaued at around 1/5 of global reserves rather than rising further. The bloc can coordinate monetary policy through the European Central Bank, but fiscal solidarity remains partial. Without it, the euro cannot project the same unquestioned stability as the dollar's treasury market. Despite these limitations, the euro provides a stabilizing role in the global system. Central banks rely on it as their second choice after the dollar. It offers liquidity, regional balance, and a hedge against dollar risk. In times when confidence in the United States weakens, Europe absorbs some flows. The presence of the euro in this role is critical because it prevents immediate collapse of the reserve currency system. If the only alternative were the yuan, diversification would appear riskier and slower. Instead, the euro provides a middle ground that sustains multipolarity. It reassures institutions that gradual reduction in dollar share does not equate to abrupt instability. That balance is what makes the euro's presence significant even without dominating headlines. Another factor to note is the euro's geopolitical character. Whereas the yuan carries association with China's ambitions and governance style, the euro benefits from being perceived as politically neutral outside Europe. Nations wary of aligning too closely with Washington may also hesitate to tie themselves to Beijing. In that context, the euro offers a compromise, stable enough, liquid enough, and not bound up in the same power struggles. This practical neutrality helps explain why central banks in Africa, the Middle East, and Asia include the euro in their reserves. It allows them to demonstrate diversification without provoking geopolitical sensitivities in either direction. The US and China may contest financial dominance, but the euro plays quietly as the balancing currency that eases the transition. Energy trade illustrates another layer of opportunity for the euro. Europe remains a major importer of energy rather than a dominant exporter, but its companies and banks handle a high volume of financial intermediation in the sector. If energy markets across neighboring regions adopt non-dollar settlements, European banks could facilitate euro-based clearing, boosting its use. The effect would be less dramatic than the yuan's targeted efforts, but could accumulate naturally through financial infrastructure already in place. Europe has a long tradition as a financial center, with hubs such as Frankfurt, Paris, and especially London, even after Brexit. That institutional depth gives the euro a backbone that supports broader global use. Still, Europe's internal debates limit ambition. The bloc faces recurring arguments over defense, migration, fiscal sharing, and regulatory detail. Each dispute saps some of the credibility the euro might otherwise hold. Investors notice when summits end in stalemate or when domestic political shifts create uncertainty on European unity. Each episode reaffirms the perception that the euro's strength depends heavily on maintaining cohesion. A rival to the dollar cannot afford fragile unity. It requires overwhelming and predictable coordination. The absence of that reliability keeps the euro locked in a stabilizing role rather than a conquering one. Its function as a second choice is assured, but its leap to first choice remains blocked. Even so, the euro matters in key ways. It anchors the system by distributing shares of reserves in a manner that reduces reliance on one currency alone. When central banks adjust their balances, euros typically absorb those reallocations as much as yuan do. Without the euro, diversifying away from the dollar would center almost exclusively on China, creating risk that many governments would avoid. By existing as a viable second pillar, the euro slows the pace of de-dollarization's impact, cushioning instability. It is the stabilizer that prevents the world from leaping straight into a binary contest between Washington and Beijing. From the perspective of American policymakers, the euro's stabilizing role cuts two ways. On one hand, it means dollar erosion does not accelerate as quickly as it might if a stronger immediate challenger existed. On the other, it shows that alternatives already exist at credible scale, so declines in the US share can continue quietly without waiting for China to catch up. The euro makes de-dollarization gradual instead of abrupt, but still represents erosion all the same. Washington cannot ignore that 1/5 of global reserves is consistently held in a rival currency issued by a bloc with independent political interests. The mini payoff here is that China is not the only actor capable of reshaping global reserve tables. The euro, although slowed by its internal politics, remains a permanent stabilizer in the equation. It does not dethrone the dollar outright, but it ensures multipolarity and reduces America's monopoly. In that sense, the story of reserve currencies is less a duel between the dollar and the yuan and more a triangle in which Europe quietly secures balance. Over time, the euro's presence guarantees that the dollar's dominance is not absolute, even if it remains in the lead. Is the dollar's exorbitant privilege ending? The phrase exorbitant privilege might sound like a label from a political speech, but in economics it refers to something very concrete. For decades, the United States has been able to buy goods, borrow money, and finance its deficits simply by issuing its own currency. Other countries do not have that luxury. If they want to import energy or food, they must first sell what they produce, earn dollars, and then with those dollars make their purchases. America, by contrast, can simply print more of its money and still expect the world to accept it. That asymmetry has been one of the main pillars of U.S. power. It gives Washington extraordinary leeway to fund wars, stimulus programs, and expansive trade deficits without facing the same constraints that weigh on other economies. The term captures the idea that this is not just privilege, it is extraordinary privilege. For much of the 20th century, the privilege felt nearly untouchable. At each moment of global uncertainty, dollars and treasuries became the safe asset of choice. Central banks held the currency in reserves not only because it was liquid, but because they trusted it to hold value and remain transferable under any conditions. Yet trust is fragile, and what we have seen over the past decade, and most clearly after the sanctions imposed on Russia, shows that using that privilege as a political weapon carries hidden costs. When Washington froze Russian reserves and cut its banks off from global payment networks, the measure hurt Moscow immediately. But it also sent shockwaves through governments and central banks in dozens of other countries. They realized that their own reserves, if kept in dollars, were only secure so long as political relations with the United States stayed friendly. That realization matters. A reserve currency works not just because of its economic weight, but because it is seen as neutral and reliable. Once countries perceive that their access can be taken away by a policy decision in Washington, the sense of neutrality erodes. In simple terms, the dollar was no longer just a universal financial tool. It was now a potential instrument of foreign policy. Russia's case offered a stark demonstration. While some countries supported the sanctions, others quietly asked themselves what would happen if their own alignment with U.S. policies were to change. This hypothetical fear encourages diversification. Even governments not under threat begin to shift parts of their reserves into euros, gold, or increasingly yuan just to reduce exposure. They are not waiting to be targeted, they are preparing for the possibility. The tension is obvious. On one side, sanctions reinforced America's role as a superpower able to use financial networks as leverage. On the other, they undermined the long-standing trust that allowed others to hold the dollar without hesitation. In the short run, the sanctions worked as designed, restricting Russia from accessing its currency buffers. In the long run, the message to the rest of the world was unsettling. Dollar holdings are not sacred. They can be frozen overnight if the United States decides circumstances justify it. That recognition plants a seed of doubt, and in finance, doubt has a way of growing even when the underlying system remains strong. Fear of being next is what drives much of the diversification we are seeing now. Countries with little conflict with Washington still imagine edge cases where they may end up in its crosshairs, over trade disputes, diplomatic differences, or domestic policy choices that clash with U.S. values. Once the scenario is imaginable, the incentive to hedge is unavoidable. Central banks quietly reduce their percentage of reserves in dollars. Importers and exporters negotiate some contracts in alternative currencies to prove it can be done. Regional blocs experiment with clearing mechanisms outside of Washington's orbit. Each of these steps may look modest, but together they build an ecosystem in which the dollar's role is no longer exclusive. Alternatives become credible not because of their superior economics, but because they feel safer politically. The crucial point is that these steps are often symbolic as much as they are substantial. A central bank shifting 2 or 3% of its reserves into yuan does not change the hierarchy of global finance. An oil deal denominated in rupees might be small compared to the vast petrodollar market, but the symbolic act carries outsized weight because it signals a willingness to live without complete dependence on the dollar. In international finance, symbolism matters because it changes expectations. Once enough countries show they are willing to try alternatives, it normalizes diversification. Confidence in the dollar is no longer unquestioned. It is conditional. The condition is the assumption that it won't be used against them. That assumption grows weaker after the precedent of weaponization. Trust is a strange currency in itself. It is intangible but fundamental. The military or economic strength of the United States only explains part of why the dollar dominated for so long. The other part was a deep belief that anyone holding U.S. assets would be treated fairly, that rules would not shift abruptly, and that reserves were safe from politics. When trust erodes, privilege erodes. Investors cannot quantify it in annual reports, but they can feel it in their allocations. That erosion may move slowly through statistics. 1 or 2 percentage points of reserve shift here, a few trade contracts there, but over time it compounds. The erosion of privilege has direct consequences. Without unquestioned demand for American debt, Washington pays more to finance its deficits. Without exclusive dominance of trade invoicing, U.S. influence in global negotiations weakens. Sanctions still matter, but their potency diminishes as more transactions bypass dollar systems. The sheer convenience that once underwrote American leverage cannot be fully restored once lost. Politics intrudes, and politics creates doubt. None of this suggests the dollar is about to collapse. It remains roughly 3 times as large in reserve share as the euro, and vastly larger than the yuan. Its markets are unmatched in depth and liquidity. But the difference between unquestioned dominance and conditional dominance is profound. Unquestioned dominance grants freedom. Conditional dominance means every decision in Washington now has strategic consequences for global trust. That burden was not as heavy a generation ago, because alternatives felt minimal. Today, alternatives are available enough that actors can choose them if doubt spreads too far. For many countries, diversification is like buying an insurance policy. Even if the dollar remains stable, holding a second or third option in reserves feels prudent. The spread of these insurance policies reduces the weight of the exorbitant privilege the United States once enjoyed. Think of it as the world asking for second opinions from other doctors after years of relying on one. Even if the original doctor remains competent, the act of seeking new advice means his authority is diminished. What makes this development powerful is its feedback loop. As more countries diversify, the dollar's share falls slightly. Analysts note the trend, markets report the numbers, and expectations adjust. Lower expectations further encourage diversification, since no one wants to be the last holding an asset losing prestige. The process is cumulative, and once underway, requires little justification beyond momentum. Politics triggered the change, but economics drives the continuation. Momentum itself becomes the force. So is the privilege ending? Not in the absolute sense, but in the relative sense it already has. Printing dollars to finance deficits still works, but at slightly higher cost. Borrowing freely still works, but with less automatic demand. Sanctions still sting, but countries prepare more workarounds. The privilege is eroding rather than vanishing. The world no longer accepts the dollar unconditionally, but with caveats. And caveats in finance mean higher costs, reduced leverage, and slower growth of influence. The mini payoff is clear. When trust in political neutrality erodes, trust in the currency erodes right alongside it. America's unique privilege was built not just on economic power, but on belief in stability and fairness. Once that belief weakens, every tool Washington uses becomes a little blunter. Privilege shrinks not with spectacle, but with steady hesitation. The erosion of political trust and the erosion of financial dominance turn out to be the same story, told in 2 different languages. What investors can actually do. When the conversation turns to de-dollarization, it's easy to get lost in the big picture. Central banks shifting reserves and governments signing bilateral trade agreements can feel very far away. But investors at home need to translate all that chatter into portfolio choices that actually make sense. The temptation is often to react dramatically, liquidate dollar assets, convert into foreign currencies, or go all in on gold. That kind of reaction, however, risks doing more harm than good. The better approach is slower, more deliberate, and rooted in diversification rather than abandonment. Diversification here does not mean turning your portfolio upside down. It means adjusting exposure so you are not completely reliant on a single currency or a single asset class. Most American investors naturally hold heavy positions in U.S.-denominated assets, whether through bonds, domestic equities, or simple cash holdings. To recognize shifting global preferences, the move isn't to sell those, but to add protective layers. Opening positions in foreign funds, global index trackers, or even regional ETFs can begin to balance risk. These foreign exposures provide currency diversification automatically. If the dollar weakens relative to others, returns from overseas holdings help cushion the loss. Exposure to real assets provides another hedge. Inflation lingers against the backdrop of currency uncertainty, and assets tied to physical goods often provide stability when paper assets weaken. Real estate continues to serve as one buffer. Infrastructure funds offer another. Commodities, though volatile, plug into the same logic. A broad allocation to real assets shields portfolios from both inflationary cycles and creeping erosion of the dollar's unique buying power. The purpose is not speculation on commodity spikes, but protection against sustained currency adjustment. Gold has reemerged as a practical hedge, not because it yields income or compounds wealth like growth stocks, but because it sits outside the trust structures that define the dollar system. Central banks have turned to it as insurance, not as their primary reserve. Similarly, private investors can treat it as insurance inside their allocation. Small percentages of a portfolio dedicated to precious metals achieve the effect without distorting risk. The case is not that gold replaces the dollar. It is that gold hedges the tail risk of dollar weakness. Investors must also resist the urge to overreact. It's easy to hear predictions of collapse and imagine you should dump all dollar exposure. But that's neither realistic nor effective. The dollar still underwrites the deepest capital markets in the world, and abandoning those entirely would lock you out of highly liquid, highly functional systems. No other currency presently offers the same breadth of access to equities, bonds, and derivatives as the dollar. Selling all exposure would reduce efficiency rather than improve it. The risk of missing gains outweighs the risk of holding balanced exposure. In simple terms, you can't operate a modern portfolio by pretending the dollar no longer exists. A useful way to frame it with a bit of humor is, don't throw your dollars out the window just yet. They still pay the bills, still anchor retirement accounts, and still dominate global payments. What investors should consider is keeping a second and third option in their pocket. Think of it like carrying insurance on your house. You don't sell the house because of risk, you insure it in case of loss. Portfolio hedging through diversification mirrors this logic. So what does a balanced approach look like? Imagine a portfolio where U.S. equities and bonds still hold the majority, but foreign equities, select sovereign bonds outside the dollar, a small allocation to gold, and perhaps exposure to real assets like infrastructure provide a surrounding hedge. That structure recognizes both resilience of American markets and the reality of gradual erosion in the dollar's privilege. It's not panic selling. It's positioning for probability. If the dollar remains dominant, your core U.S. assets continue to perform. If the dollar slips, the other exposures catch some of the slack. Institutional investors are already modeling this recalibration. Sovereign wealth funds and central banks are not exiting treasuries, but they are trimming positions at the margin, buying more euros, yen, or gold. The pattern is not flight, but adjustment. Individual investors can copy that logic at smaller scale. A 10 or 15% adjustment in portfolio structure achieves the aim. The mechanics are straightforward. Global equity funds, international bond ETFs, or commodity baskets fulfill the brief. The simplicity makes adjustment feasible even for retail investors without access to complex strategies. Domestic fixed income still deserves a place. Treasuries may face more volatility, yet they remain liquid and serve as core defensive assets. Removing them entirely would increase, not reduce, risk. What changes is how much you rely on them. Rather than dedicating overwhelming shares of portfolios to bonds that could underperform in a prolonged weakening of the dollar, blending them with other safe options like German or Japanese sovereign debt through international bond funds spreads exposure. These instruments belong in preservation strategies, not in speculative swaps, because they hedge the structural environment rather than bet on abrupt shifts. Younger investors often wonder if diversification should mean adding cryptocurrency exposure. Digital assets undeniably reflect skepticism about fiat systems, but their volatility is extreme. A useful framework is to treat them similarly to highly speculative technology equities. Possible allocation at the margins, but unsuitable as core portfolio insurance. Unlike gold or sovereign bonds, crypto prices can swing so widely they may fail precisely when stability is required. Treating them as insurance misreads the category. Treating them as speculative venture exposure may be more fitting. Another overlooked area is emerging market funds. They carry higher risk, but they also represent the economy's most actively negotiating trade outside the dollar. Exposure to them provides indirect balance against U.S. dominance. When those trade systems grow, local markets and currencies benefit. For investors, small exposure here captures the upside of multipolarity. The balance, again, is small allocations rather than massive shifts, because volatility in emerging markets is intense. Yet the strategic role they play in de-dollarization means excluding them entirely overlooks part of the adjustment process. Investors also must evaluate timelines. Erosion of dollar dominance is a slow process that allows time to adjust without fear of overnight collapse. Positioning gradually ensures fewer mistakes driven by panic. Reacting in all-or-nothing fashion ignores the generational pace of change in reserve systems. Calm adjustments matter more than rapid shifts. Gradualism reflects the reality that de-dollarization is cumulative, not instantaneous. Overreacting to latest headlines creates churn in portfolios instead of stability. Even within domestic assets, investors can hedge. Multinationals listed on U.S. exchanges earn revenues worldwide in multiple currencies. Purchasing those equities provides implicit foreign currency exposure. Real estate investment trusts tied to global logistics or international leasing create similar indirect diversification. Investors can diversify beyond the simple dollar versus non-dollar binary by recognizing U.S. corporations themselves straddle global flows. Allocation to these businesses functions as a currency hedge hidden inside ordinary equity markets. Discussing strategy also requires recognizing psychological discipline. Investors who consume constant headlines about the end of the dollar may overallocate defensively, missing gains in core markets. The balance is mental as well as financial. Expect slippage, prepare for erosion, but avoid framing every change as existential. Investing is as much about managing narrative as managing numbers. The narrative of collapse fuels poor decisions. The narrative of gradual adjustment encourages steady hedging. Balancing strategies extend into debt management for households as well. If interest costs in the U.S. remain elevated because foreign demand for Treasuries weakens, personal borrowing costs will track higher. Managing variable rate debt carefully becomes as strategic as adjusting portfolios. Households should consider fixing loans at predictable terms, reducing exposure to sudden rate hikes. Currency privilege translates into real borrowing conditions. As privilege erodes, personal finance strategy becomes part of investment preparation. At the institutional level, some investors build positions in infrastructure tied to critical resources. Pipelines, power grids, and transport networks provide tangible yield regardless of currency movements. Income derived from these assets offers reliability that hedges against currency instability. Ordinary investors can participate through listed infrastructure funds. These forms of real asset allocation embody the principle of hedging without abandoning traditional securities. They create another layer of diversification that prepares portfolios for slow erosion of the dollar system. Critically, no single adjustment replaces the dominance of U.S. assets. The dollar remains intertwined with global markets in a way unmatched by any other currency. Investors cannot construct viable portfolios completely isolated from it. The best they can do is spread reliance. That spreading reduces risk while retaining access to liquidity and growth. This is the realistic form of preparation. The conversation about investor strategy ultimately reflects the larger debate. Decline of dollar. Dominance is likely to be gradual. That means portfolios require balance, not panic. Adding layers of diversification, foreign funds, real assets, a measured allocation to gold provides protection. Overreaction by trying to abandon the dollar entirely is not practical. Investors must treat headlines with skepticism and translate them into modest, rational changes. The mini payoff is the recognition that the strategy for individuals mirrors the strategy for nations. Balance is better than extremes. Countries are not throwing out their dollars wholesale, and neither should investors. They hedge, diversify, and prepare. In personal portfolios, that means slow adjustment, protective allocations, and above all, discipline. The fate of the dollar may no longer be unquestioned, but investor approaches should remain calm. Survival comes not from abandoning currency leadership, but from ensuring against its erosion. Balance, not fear, is the method that works. American exceptionalism as an economic. Asset American exceptionalism often gets discussed in political speeches, but in economic terms it has very specific meaning. It refers to the set of advantages that keep the United States at the center of global finance and investment even when its policies stumble. Among these advantages are deep capital markets, a culture of innovation, and institutions that other countries still struggle to match. Foreign investors might worry about deficits or interest rates, but they continue directing capital to America because no rival offers the same mix of opportunity, scale, and safety. That dynamic is what gives the dollar resilience, even when its share of global reserves shows decline in the data. Investors ask a simple question: where else could this much capital be allocated quickly, safely, and profitably? The answer almost always includes America. Universities are one of the clearest examples of that exceptionalism. The United States houses the largest concentration of research institutions capable of producing both science and technology at global scale. These universities attract students from every continent, many of whom stay and contribute to the economy as entrepreneurs, engineers, or researchers. Knowledge created inside these institutions spills outward into industries that form the backbone of growth. From biotechnology to software engineering, the network of American universities creates a constant pipeline of ideas and talent. That steady innovation reinforces why capital flows remain strong. Investors trust that in the next decade, important breakthroughs will likely emerge in an American laboratory, not only because of resources but because of the ecosystem surrounding them. Technology firms extend that advantage. The world's dominant platforms in search, retail, social media, and cloud computing remain American, and they continue to define how global commerce works. Startup ecosystems in Silicon Valley, Austin, and Boston keep attracting venture capital that rivals entire national markets elsewhere. Even amid competition from Asia, investors still treat American tech as the gold standard for scalability and global reach. That staying power explains why international funds maintain allocations to U.S. equities, even while criticizing American fiscal instability. Innovation generates confidence, and confidence attracts capital. As long as American firms sit at the core of global digital infrastructure, the flows of money follow. The pattern extends beyond tech. America leads in pharmaceuticals, aerospace, advanced manufacturing, and finance itself. Each sector generates spillover benefits in employment and productivity. For foreigners deciding where to store wealth, these industries create reassurance that economic dynamism remains alive. No other single country offers the same breadth. Some nations may specialize in one sector, but few can claim leadership across so many. That breadth secures America's place in the global portfolio of central banks, sovereign wealth funds, and private firms. Their reservations about debt or deficits are weighed against this structural advantage, and the advantage generally wins. But this strength is not automatic, and political missteps create tension within the story. When Washington engages in debt-ceiling standoffs, government shutdowns, or unpredictable trade wars, confidence wavers. Foreigners question whether America takes its responsibilities as steward of the global currency seriously. Episodes of instability hurt perception because they suggest dysfunction at the heart of the system. Investors may forgive mistakes, but repeated crises erode trust, adding momentum to diversification away from the dollar. The contradiction is that America has built structural strengths few can rival, but its leadership sometimes undermines those strengths by projecting chaos rather than stability. Partisanship adds to this problem. Long-term policies needed to preserve confidence often collapse into short-term political fights. Infrastructure investments, education reforms, and fiscal discipline could reinforce the structural advantages of innovation and capital markets, but instead they become casualties of political gridlock. Investors watching from abroad care less about which political party prevails than whether the system produces predictability. Each round of political stalemate reinforces the impression of fragility. The tension grows sharper because the fundamentals remain strong. Silicon Valley does not close because Congress argues, but the perception of risk affects how foreigners judge the future of the dollar. The resilience of American fundamentals explains why the system endures despite these missteps. Innovation capacity, elite universities, and dynamic markets are not erased by short-term political dysfunction. These strengths operate on generational timescales. It takes decades to build institutions capable of producing the next wave of technological breakthroughs, and America has already built them. It takes centuries to accumulate the depth of markets capable of absorbing trillions of dollars in global flows, and the United States already has that. Political dysfunction may dent confidence, but it struggles to erase these deeper foundations. At most, it slows momentum or shapes perception. Foreign investors know this. That is why even when diversification into euros, yen, or yuan increases, treasuries remain the largest asset class in their reserves. Investors complain about U.S. deficits, but then allocate capital to America anyway. They hedge at the margins, but do not abandon the market. This behavior reflects recognition that no other nation offers comparable long-term security combined with economic dynamism. The euro suffers from political division across the bloc, the yuan suffers from closed capital markets, and emerging markets suffer from volatility. America's flaws look manageable in contrast. Investors balance doubts with pragmatism, and pragmatism keeps dollars attractive. Another element of the exceptionalism is the legal framework. Property rights, contract enforcement, and a relatively transparent judiciary provide security for investors. In many competing economies, uncertainties over law enforcement or arbitrary regulation undermine trust. America's system has imperfections, but compared to rivals, it offers consistent protection for capital. That structural trust invites long-term commitments in ways that weaker institutions elsewhere cannot. Foreign students who come to American universities often stay because they trust the legal and business environment to support their pursuits. Investors make similar calculations with their assets. The reputation of American culture as innovative and entrepreneurial further supports the system. Talent around the world migrates to the United States because the environment rewards risk-taking and scale. Venture capital can back a new firm that grows from a garage into a global giant within a decade. Other countries foster entrepreneurship, but often with less access to capital or less tolerance for high failure rates. America's cultural capacity to convert ideas into global companies reinforces its attractiveness. Investors respond not to political gridlock, but to the practical reality that the next transformative firm is more likely to be born in California than in competitor states elsewhere. Of course, the same openness that supports innovation also produces vulnerability. Immigration debates, regulatory uncertainty, and cultural divides create friction that occasionally slow the influx of talent. If harsher domestic politics deter foreign students or entrepreneurs, one of America's core assets risks erosion. Structural advantages cannot be taken for granted. They remain resilient but require maintenance and openness to sustain. Political missteps therefore pose real risk if repeated with enough intensity or frequency. Yet history shows that setbacks do not erase the fundamentals. After the 2008 financial crisis, commentators questioned whether America had discredited itself permanently. Foreign investors fled temporarily, but within years capital returned. Markets recognized that innovation ecosystems, universities, and entrepreneurial culture remained intact. America reabsorbed global investment because the foundations endured. This precedent demonstrates why pessimism about collapse often overshoots reality. Political mismanagement creates real costs, but the structures underneath outlast cycles of dysfunction. The persistence of these foundations is the resolution to the tension. Political failures may shake faith, but economic fundamentals remain. As long as innovation pipelines keep producing technology and science, as long as universities attract global talent, and as long as legal institutions protect capital, the United States retains its role as the world's engine of investment. That continuity makes sudden collapse stories less credible. Investors calibrate exposure, but rarely abandon. They know that volatility in Washington circles does not erase the core logic of putting money into American growth. Markets may waver, exchange rates may fluctuate, and diversification may grow, but U.S. fundamentals are not vanishing. The networks of universities, the dominance of technology, the breadth of innovative sectors, all remain. These are assets that no foreign policy mistake can dismantle quickly. They are the reason why, despite headlines about de-dollarization, capital still flows into American equities, bonds, and Start UPS. For decades to come, these structural features will cushion the dollar's erosion. The privilege may be shrinking, but the foundations continue to reinforce America's place at the core of global finance. The mini payoff is that despite political stagecraft and fiscal instability, the fundamental strengths of America's economy keep investors engaged. Exceptionalism in technology, education, and culture can carry the system through periods of mismanagement. Markets may doubt, diversify, or hesitate, but they cannot ignore. The innovation engine, the universities, and the culture of entrepreneurship secure a baseline of resilience. It is this baseline that ensures the U.S. remains central to the global economy, even as the dollar's dominance faces contest. Why currency shifts take decades to materialize. When people hear that the dollar might lose its reserve status, they often picture an overnight collapse, as if one day the world wakes up and the greenback has been dethroned. But global currency leadership does not work that way. History shows us that shifts in reserve currencies tend to unfold over decades, not months. The most important example is the British pound. At the height of the British Empire, sterling was the central currency used for settlement, reserves, and trade. After the First World War, Britain's economic leadership was severely weakened, and by the end of the Second World War, the United States had overtaken it as the dominant financial power. Yet the pound did not simply vanish as a global reserve currency in 1945. Central banks held large amounts of sterling well into the 1960s, and London remained one of the busiest financial centers in the world. That gradual decline shows how even when the underlying economics shift, the currency embedded in the global system takes years to unwind. The reason for this slow erosion is not simply nostalgia or political loyalty, it is structural inertia. Financial systems rely on habits, contracts, relationships, and infrastructure that cannot be rewritten instantly. If a central bank holds billions in sterling bonds, the decision to reduce those holdings requires coordination with trading partners, adjustment of payment systems, and reallocation of reserves. None of that happens quickly. Importers and exporters have long-term contracts denominated in a currency, and even if they decide in principle to shift to another, renegotiating deals takes years. Banks build their systems around particular currencies, and retraining staff, upgrading platforms, and establishing new legal structures is a time-consuming exercise. This structural stickiness is what kept the pound relevant long after Britain's relative power had ebbed. People outside finance often underestimate this inertia because they assume that once an economy weakens, its currency should drop right alongside it. But currencies are more than mirrors of GDP. They are networks of trust, transaction habits, and institutional plumbing. The pound illustrates this clearly. Even after Britain ceded military and economic leadership to the United States, London's financial system retained deep pools of expertise. Firms around the world continued to rely on London for insurance, banking, and trading services, many of which were denominated in sterling. That existing infrastructure bought the pound decades of relevance, not because it was the strongest choice in theory, but because it was the established choice in practice. The same logic applies today when we examine the dollar. Even as its global share has slipped, the infrastructure surrounding it remains enormous. Payment systems from New York to Singapore run primarily in dollars. Accounting standards around the world reference dollar benchmarks, and corporations spanning multiple continents draw up contracts in dollars by default. It is not enough for the yuan or the euro to be theoretically attractive. They must also replicate the dense network of institutions and relationships that make dollar usage efficient. Recreating that network takes time, investment, and repetition. This built-in delay is why transition stories always run on a generational clock rather than a news cycle. There is also an important psychological factor. Market participants deal not only with balance sheets, but with trust. Central banks are conservative institutions. They do not rewrite their strategy every time they detect a headline about dollar weakness. Instead, they manage reserves slowly and cautiously, guided by continuity. They would rather move late than move rashly. That conservatism locks old structures into place, reinforcing inertia. It is why diversification away from the dollar shows up as a gradual process in statistics. Small percentage changes accumulating over years, rather than sudden mass exits. The same conservatism kept sterling alive in the reserves of dozens of central banks at a time when Britain's empire had already dissolved. Financial centers are another piece of the puzzle. When Britain lost economic dominance, London did not lose relevance. Its banks continued to intermediate global transactions, its legal system remained trusted for contracts, and its trading desks attracted global capital. These advantages gave sterling outsized longevity. Today, financial centers like London also demonstrate how influence outlasts raw economic power. Even though the European Union has grown larger in scale, and New York is the primary global hub, London still plays a structural role in trading, clearing, and finance. The same will hold for the dollar, even if erosion continues. New York's depth of expertise, its liquidity, and its systems give it staying power. Stripping that away does not happen quickly. The tension lies in how the public imagines collapse. People commonly hear warnings about the dollar's decline and assume that once alternatives appear, the dollar's role ends suddenly. Perhaps they picture a currency crash where prices reset overnight, leaving Americans holding a currency no one wants. That perception builds anxiety, especially during periods of inflation or political crisis. But this imagined collapse is inconsistent with every past example. The pound declined slowly because investors and institutions had to unwind their positions steadily. Even when the dollar itself eventually faces larger declines, the inertia of existing contracts, clearinghouses, and habits mean an instant disappearance is unrealistic. This misunderstanding is intensified by media narratives. The idea of a reserve currency collapsing overnight makes for dramatic headlines. It's easier to portray the story in simple terms. Yesterday the dollar was king, tomorrow it was dethroned. Gradual erosion is harder to narrate in sound bites. Yet for investors and households alike, gradual erosion is the story that matters. If borrowing costs rise a little higher each year, if imports become marginally more expensive over time, the effect is no less serious than a crash. It simply unfolds differently. People may not notice the step at any single moment, but they feel the aggregate over a generation. That is why understanding inertia is more important than chasing collapse narratives. Structural inertia also means that even when the dollar loses share, it will remain relevant for decades. Currency usage is not all or nothing. The pound lost global primacy, but did not vanish. Sterling remained a secondary reserve currency. London retained global significance, and transactions continued to take place in the old framework even after the US dollar became dominant. The same will almost certainly apply if the dollar's relative share falls further. Even if the yuan or euro captures more market space, the dollar will still serve as a reserve currency, perhaps not at 2/3 of global reserves, but at a substantial minority share. It shifts from unquestioned leader to first among equals. It adjusts rather than disappears. This distinction matters greatly for households worried about sudden collapse. Expecting an instant breakdown leads to panicked decisions that may backfire. Dumping investments prematurely, hoarding assets inefficiently, or buying speculative insurance in ways that harm long-term finances. Recognizing inertia allows for a calmer response. Individuals can diversify portfolios gradually, businesses can hedge exposure over time, and policymakers can manage adjustment rather than emergency. That perspective prevents fear-driven overreaction. The resolution, then, comes from recognizing that finance moves on a timeline that resists instant drama. The unwind of old structures is laborious because they are woven through contracts, institutions, and psychology. This is the reason currency shifts always extend across decades. It is why the pound endured long after Britain lost global dominance, and why the dollar will endure long after new rivals gain ground. The decline may feel visible in statistics and headlines, but in everyday operations it manifests more like background noise. Subtle changes in cost, yield, and preference that accumulate slowly. The mini payoff here is straightforward. The dollar is not headed for sudden replacement. It is headed for adjustment, a long-running process shaped by inertia. That adjustment may reduce America's privilege and raise costs over time, but history suggests the currency will linger as a global pillar far into the future. Expect continuity with incremental change rather than collapse, because in global finance, structural weight ensures that even declining empires leave behind currencies that survive in practical use long after their peak has passed. At the end of the day, the story is not one of immediate destruction, but of drawn-out transformation. Markets do not abandon overnight what they built over a century. They adapt, reprioritize, and gradually rebalance. That rhythm ensures the world sees adjustment rather than whiplash. It ensures the dollar, like the pound before it, remains alive in the arteries of trade and finance for decades, even as its primacy slips away. And it means that for ordinary people, the change will arrive not as a sudden shock, but as a slow shift in background conditions that redefine prosperity generation by generation. The real risk isn't collapse, it's higher costs. A weaker dollar doesn't mean the sky is falling, and it doesn't mean the US economy collapses overnight. The real effect is much less dramatic and far more uncomfortable. Things gradually get more expensive. The stories about the dollar losing global dominance often sound catastrophic, but the truth is that reserve currency shifts hurt through subtle, persistent costs rather than spectacular meltdowns. That means the danger is not that banks suddenly reject dollars, or that Americans wake up with a currency nobody wants. The danger is that debt servicing grows heavier, imports creep up in price, credit gets tighter, and markets adjust psychologically in ways that leave people poorer even when they can't pinpoint exactly why. The clearest spillover shows up in debt servicing. When the dollar commands global confidence, the U.S. government enjoys unusually low borrowing costs. Even large deficits look manageable because foreign investors are willing to absorb treasuries at modest yields, trusting the dollar's network effects. But when that trust weakens even a little, investors ask for more compensation. Yields climb, and the cost of borrowing rises. This happens not just once, but year after year as deficits roll over into new debt at higher interest rates. Slowly, the federal budget shifts. A larger percentage of annual spending gets devoted to paying interest instead of funding services or investments. In the short term, America can absorb higher costs. Over time, compounding interest payments start to crowd out priorities from defense to infrastructure. The privilege of cheap debt fades, replaced by the slow drag of expensive servicing. That drag looks abstract on paper, but translates into fewer public services, tighter budgets, or higher taxes for citizens. It isn't collapse, but it is erosion. Imports are the second channel. The dollar has long given Americans unique purchasing power in global markets. Because it has been the dominant invoicing currency, exporters worldwide readily accepted it, holding the proceeds in reserves or using them to pay suppliers. That cycle smoothed America's trade deficit, allowing consumers to enjoy lower costs on goods from cars to electronics to food. As countries shift into trading with alternatives, the demand for dollars in those specific contracts declines. When the dollar softens relative to other currencies, importers have to pay more to secure the same goods. This extra cost travels down the chain. Retailers pay more, customers absorb the prices, and what once felt cheap and abundant begins to feel pricier. It doesn't arrive like a one-time shock. It seeps in slowly. Grocery bills creep up, new phones edge into luxury categories, cars get pricier even without better features. Inflation isn't only about domestic policy. It's about the global position of the currency. A dollar that buys a little less abroad means grocery and retail prices rise at home. Credit markets become another casualty. If the reserve system shifts gradually away from the dollar, global investors diversify their portfolios. That reduces the automatic inflows into U.S. assets that once kept borrowing cheap. Banks then adjust interest rates upward to account for higher costs of capital. Mortgages remain expensive, credit cards carry heavier interest, and business loans require more revenue just to be viable. The story here isn't dramatic defaults. It's fewer opportunities and slower growth. Businesses hesitate to expand, households hesitate to refinance, and economic dynamism slows. The tighter availability of credit reproduces the same drag as import costs. Not collapse, but a subtle reduction in prosperity that builds over time. Psychological effects amplify these economic ones. Markets respond to expectations as much as to reality. If investors perceive that the dollar is gradually losing dominance, they price that perception into contracts, hedges, and reserves. That in turn makes the perception real. Companies begin to diversify their invoices, banks begin to build hedging systems, central banks shift their allocations. Each of these responses further ingrains the idea that the dollar is riskier than before. The perception of fragility becomes self-fulfilling, not because structural collapse has arrived, but because actors behave as if it might. Financial history shows this feedback loop is powerful. Sentiment shifts first, data follows later. The practical consequence is that investors treat the dollar as one of several important currencies instead of the singular foundation. That status change reinforces slower growth of American privilege, translating again into higher costs for citizens. The erosion of prosperity is best understood as compounding rather than catastrophic. You won't see it on a chart with a dramatic cliff. You see it in incremental changes that seem unconnected. The government spends more on interest payments, meaning fewer funds for infrastructure. Imports cost a little more, meaning households stretch their paychecks further. Credit shifts upward, meaning fewer mortgages are affordable. None of these is the end of the dollar, but together they chip away at standard of living. By the time households notice, the changes are already embedded. They can't identify one moment of collapse, only the persistent pressure that their income doesn't stretch as far. Another element here. is how prolonged inflation interacts with currency weakness. If the dollar buys less abroad, domestic inflation proves more difficult to control. Even when the Federal Reserve raises interest rates, imported cost pressures keep prices stickier than expected. This means inflation does not fade quickly. Economists describe it as imported inflation. Domestic policy collides with external weakness to pin prices higher. For households, it feels like a cycle that resists solution. Parents facing grocery bills don't care that economists debate reserve status. They only care that costs never seem to fall. The prolonged inflation cycle becomes the household translation of reserve diversification. The same logic applies to energy. Oil contracts denominated in currencies other than dollars signal less automatic demand for U.S. currency. If more of the world pays in yuan, euros, or rupees, demand for dollars shrinks marginally. That can raise costs in energy markets when denominated back into dollars. The pump price for gasoline moves with global benchmarks, and if those benchmarks diversify their settlement currencies, the correlation with the dollar changes. A weaker currency subtly magnifies the dollar cost of each barrel imported. This magnification feeds back into transportation costs, electricity bills, and everything moved by trucks. Again, it is not spectacular collapse. It is persistent erosion working through ordinary bills. Debt dynamics illustrate another danger. As government outlays tilt toward interest payments, private sector borrowing also feels the squeeze. Banks and investors view high overall debt levels as riskier, so they build higher spreads into rates. Entrepreneurs find financing harder to access. Households face steeper conditions for ordinary loans. Growth engines sputter. The cycle is not visible as a single event, but the cumulative weight drags productivity. Future generations inherit the same debt, and the proportion of national income spent on servicing creditors grows. This is not financial apocalypse. It is the steady diversion of resources from productive uses into interest payments. Citizens pay through reduced opportunities rather than currency collapse. The psychological side extends into cultural perceptions. When citizens hear repeated speculation about dollar decline, confidence in their own financial system thins. Even if the mechanics are slow, perception of vulnerability creates hesitance. Families save more out of caution, delaying spending that would support growth. Investors pull back slightly from risk. The sentiment itself becomes a shadow tax. Economies slow not only because cash flows cost more, but because households act more defensively. This hesitation represents another channel of erosion. Prosperity drains not only from actual costs, but also from fear of future ones. Crucially, none of these effects produce the kind of crack headline that says the world has ended. They are diffuse, subtle, and cumulative. That makes them harder to notice, but also harder to reverse. Once investors demand higher yields, they grow accustomed to them. Once households expect imports to cost more, habits adjust downward. Once markets question automatic dominance, they create structures to support alternatives. Reversing trust requires decades. The impact of decline therefore appears as higher costs baked into expectations rather than financial collapse resetting the system. This is what makes the story important. Collapse would be dramatic, but also temporary. Systems rebound from crashes. What does not rebound easily is long-term erosion. The dollar does not need to topple to reduce prosperity. It only needs to weaken enough to make everything more expensive bit by bit. That is the real danger facing households and policymakers alike. The mini payoff here is that the risk is not Hollywood-style collapse. It is the grind of higher costs across debt service, imports, credit, and inflation. Prosperity erodes slowly, not with explosions, but with tiny cuts compounded over years. Understanding this difference prevents panic on one extreme and complacency on the other. The dollar may weaken without vanishing, and that weakening matters most because of the way it seeps silently into every budget. For Americans, the loss of privilege shows up one bill at a time, long before anyone declares the currency's formal dethronement. The humor behind doom predictions. For as long as anyone can remember, there's been a cottage industry in predicting the end of the dollar. If you trace it back, you can find commentators in the late 1970s insisting that inflation and deficits meant the currency was doomed. In the 1980s, Japan's economic rise gave the predictions new life. By the late 1990s, the introduction of the euro was promoted as the fatal blow. Then in the 2000s, America's wars and borrowing habits became the new explanation. And during the 2008 financial crisis, once again, the columnists and newsletter writers dusted off the phrase "death of the dollar." The repetition is striking because here we are in 2025, and despite the dollar's declining share in reserves, it remains the backbone of the world's financial system. These doom predictions catch attention because they play into familiar fears. That wealth built on paper is brittle, that politicians have mismanaged trust irreversibly, and that empires inevitably overreach. The pattern of rising power and declining currency is a compelling story, especially when it's presented with charts comparing America today with Britain in 1945 or the Netherlands centuries earlier. The logic seems airtight, history repeats, and the dollar cannot escape its turn. But what's often missing from those headlines is that historical cycles take far longer to unfold than a frightening article suggests. Generational arcs are compressed into sound bites, which makes predictions feel urgent even when the reality is slow. Satire helps highlight the absurdity. A running joke among economists is that the dollar has been dying for 40 years. That's not far off. The same prediction is recycled each decade with only the details swapped out. In the 1980s, it was competition from the yen. In the 1990s, it was the euro. In the 2000s, it was China's rise. In the 2010s, it was US debt and near-zero interest rates. Each decade supplied its own villain, but the script barely changed. Forecasts painted a picture of imminent collapse, investors braced for disaster, and yet the system kept functioning. The joke underscores a key point. Just because the warnings are repeated often doesn't mean they're wrong, but it does mean they are often exaggerated into drama more than accuracy. The financial commentary industry thrives on alarm. Predictions of stability don't sell newsletters, but warnings of collapse do. When someone declares the end of the dollar order, it creates urgency, even when the evidence doesn't back up the timeline. This dynamic explains why so many of these predictions turn out wrong. Not because the risks aren't real, but because the delivery is designed to jolt audiences. Headlines about collapse attract attention, whereas charts showing a slow drop in reserve share sound dull. People prefer apocalypse narratives to erosion narratives, so that's what gets published. Erosion, however, is the reality confirmed in the present data. That doesn't mean there are no real risks. The dollar's share of reserves has declined steadily. Trade agreements excluding it have multiplied. Central banks openly talk about hedging their holdings. These are not fictions, they are developments shaping tomorrow's landscape. The danger arises when those realities are translated into false urgency. Saying that the dollar has slipped a few percentage points creates less drama than claiming world reserve status lost. The difference between commentary and reality sits in that translation. Real risks exist, but they are exaggerated to make stories marketable. Another way to look at it is through the lens of empire cycles. Analysts frequently compare America to Rome, Britain, Spain, or the Netherlands. The implication is that because every empire declines, the dollar must collapse in the same way. But these comparisons often skip over details like institutional resilience, innovation, or the sheer scale of global entanglement. The United States in the 21st century is not Britain in 1945. Information technology, capital mobility, and the interconnectedness of global economies make transitions slower. Comparing chart lines makes good rhetorical theater, but strips complexity out of the analysis. That oversimplification makes decline feel like destiny rather than process. Humor can break that narrative by exposing how recycled it is. To imagine the death of the dollar prediction is like a rerun of a TV show. You already know the plot. Each season introduces a new challenger. The narrator declares the crisis, and by the finale the dollar survives, albeit with a smaller share or new worries for the next season. The series never ends, because financial markets are permanently anxious. Investors turn this into a dark comedy. The end gets announced so often that its credibility weakens, but the show keeps getting renewed anyway. For average people hearing these predictions, the danger lies in overreaction. If you interpret every headline as a sign of imminent collapse, you might cash out of markets, overbuy hedges like gold, or abandon balanced investment strategies. That fear can produce bigger personal losses than the dollar's actual erosion. Families who panic sell during each wave of predictions often miss subsequent gains when stability returns. The pattern repeats as often as the headlines do. Doom predictions harm not simply because they exaggerate, but because they encourage poor decision-making. At the same time, ignoring the risks entirely is unwise. Dismissal can breed complacency. If households or policymakers assume doom predictions are always false, they risk overlooking the ways erosion builds over time. Remember, the British pound did not vanish overnight, but it did decline steadily. Those who ignored the trend failed to prepare. The trick is to balance skepticism of alarmist headlines with recognition that slow movement is real. Knowing that predictions are exaggerated does not mean the underlying forces are imaginary. This tension between exaggeration and reality sits at the heart of why the topic generates so much confusion. On television panels, strident voices dramatize collapse as if tomorrow will launch a global reset. In academic reports, cautious analysts write about incremental shifts stretching over decades. Both are gazing at the same data. One chooses to dramatize, the other to contextualize. Audiences then struggle to reconcile the theatrics with the reality, unsure whether to expect fireworks or quiet leaks. The mismatch is deliberate. Headlines dramatize because drama sells. Cautious voices remain quieter because gradual erosion is harder to market. The truth nearly always rests in the middle. The dollar is not invincible, but it is not dying overnight either. It is losing share, but from a position of dominance. It faces rivals, but none has matched its liquidity, legal system, or market depth. The risks are real, but the timeline is messy. Collapse makes for gripping stories. Erosion produces real consequences. Both fit into the narrative, and that tension will keep fueling predictions. The exaggeration will keep resurfacing because it feeds both fear and profit. Recognizing this pattern helps investors and citizens distinguish between financial theater and actionable reality. Theater is the phrase, "end of dollar dominance tomorrow." Reality is higher debt costs, pricier imports, and long-term inflationary pressure from a currency whose privilege is eroding gradually. Theater pulls people toward panic moves. Reality allows them to hedge calmly. Theater tends to fuel social media debate. Reality creeps into budgets. The distinction determines whether the conversation stays productive or spirals into distraction. It's worth remembering that accuracy often sounds boring, which is why alarmism dominates. Saying the dollar will gradually lose influence, requiring diversification across decades, is technically correct but lacks drama. Saying the dollar will collapse tomorrow is exciting but repeatedly wrong. People chase excitement, so they consume doom predictions the way they consume disaster films. Entertainment value overtakes accuracy. This is why you can find endless YouTube videos, blog posts, and newsletters claiming imminent collapse year after year. Accuracy does not sell, apocalypse does. But hype should not blind audiences to the fact that decline, even if gradual, matters. Each percentage point of reserve lost, each incremental rise in borrowing costs, each additional trade deal settled without dollars reduces privilege. That is the actionable reality hidden beneath reams of alarmism. While collapse is unlikely, erosion already produces costs. The everyday impact is not headlines about dethronement, but higher mortgages, pricier goods, and tighter credit. The tragedy of financial theater is that it obscures these everyday pressures by promising a cinematic finale that never arrives. By laughing at the repeated predictions, viewers can regain perspective. Knowing that the end of the dollar has been announced for 40 years puts current claims in context. Humor disarms the fear that narratives exploit. But laughter should be balanced with sober recognition that privilege is quietly slipping away. The dollar may not collapse like the headlines promise, but it does erode. That middle zone is where individuals should focus attention, on preparation, not panic, on diversification, not abandonment. The mini payoff here is that audiences can treat much of the financial collapse commentary as theater. Predictions of doom entertain, but they rarely describe reality in full. The genuine story is slower, subtler, and more costly over time. Recognizing the difference between spectacle and structure allows people to prepare wisely. Alarmism sounds exciting, but distracts from the work of gradual adjustment. And the humor lies in seeing how many times collapse has already been predicted without materializing. The end of the dollar is the sequel that never stops running, but the real plot is erosion creeping forward year after year. The decline of the dollar is not a sudden shock, but a drawn-out adjustment, and the effects are already filtering into everyday life through higher borrowing costs, persistent prices, and tighter credit. What matters now is less about whether the dollar fades and more about how well both individuals and the government adjust to the loss of its unique privilege. Collapse is unlikely, but erosion is real. Staying aware of this slow process allows people to prepare sensibly, balancing investments, managing debt, and recognizing long-term change. The right response is not panic, but careful positioning for the decades ahead.